Hey, trader friends, it's old school, back to OG today with Rich and myself.
Welcome to Trade Live with IG, everybody. It is Thursday, the 14th of August.
Yeah.
Middle of August.
Exciting.
Done.
Still, maybe not just yet. We're still waiting on potential correction. But Julian Wheeler, who's coming in today, our new guest, trader friends, says, don't wait any longer. He doesn't think it's coming.
Whatever. I'll leave for that one.
Trigger.
So yeah, there is beautiful London this morning. That's right. You can almost see those non-dom private jets leaving out of London City Airport. We can catch them live on camera as they go, because of course that's the big story of the morning. Apparently, only 25% of them are leaving, so it's fine. Get the taxes up more. Come on.
Did you see some of the memes yesterday? Some of the, lots and lots of chat about, planes being used, planes with non-doms, planes.
Being used for what?
Those non-doms like leaving. The Bitcoin advert. Have you seen the Coinbase ones as well?
No.
Oh, you haven't.
What are you?
Well, it's all linked to some.
Well, she's having a this morning because UK GDP through the roof. We're going to come on to that shortly, along with what else is coming up on today's show.
Here we go. Right, so we've got, and then we have a bit of an in with Axel sometime this morning.
Axel's coming to join me at 8:50. Fast Markets. We're going to have a little bit of technical chats.
Yeah, and then we've got myself and the partner at Shard Capital, Julian Wheeler, who is also an expert in US stocks.
Can't wait for that one. And how do you know Julian?
Julian, we go way back because the connection is Bill Blaney.
Ah,
yeah, good. Who also used to be at Shard Capital.
Right, I'll come on to that in a minute. So then you've got Big Jack. Jack is back.
Jack. He's back to talk about what it's looking like in the coming volatility and how to play that as we've got more earnings from consumer names in the US.
Sorry, what's going on at 9:10?
Man versus.
Are you the machine?
I'm the man.
Smart Harris then.
He is the. Yes, his machine is AI.
Right.
So he's going to pit me against it. Ill.
There you go. Machine doesn't take a holiday.
No, that's right.
And then 9:35. What you got for us there?
So I'm very excited about this. We have and final episode with. For those of you that watched the previous episodes, this is the grand finale, where he is going to talk about all things related to why crypto matters now more than ever and the future of this new and developing asset.
Now, for people that have missed your crypto specials, what can they expect if they go back onto the website and they on the YouTube, and they look at decoding crypto? What are they going to learn?
The best thing about this is you don't have to be an expert trader, friend. In fact, it takes you and handholds you right from the beginning. Episode 1 just tells you plainly, what is crypto? How is it built? Why is there so much interest in the space? And then we build it up, we ramp it up for you very slowly though. And we discuss, how it emerged, how it is developing, why you should be interested, even if you don't have a position in it or you do, how that space in terms of regulation is developing both in the US and here. And we end with today's episode telling you why it matters, why you need to sit up and pay attention, and how it is going to perhaps matter in the future.
Well, you've timed that well, because I think Bitcoin just hit all-time highs.
And if
oh, no, sorry, it's come off.
Oh, dear.
Literally 20 minutes ago, Bitcoin all-time highs. And 3 in the day now. 12,180.
Whoa.
So let's go into that and more in overnight action.
Oh, yeah. Hey, trader friends, welcome back to Overnight Action. It's not just Bitcoin, Ethereum as well has been going great guns the last few weeks.
Well, you've done very well from that.
It's ahead of his impending trip up to Scotland, so his speech is starting to turn Scottish, more Scottish.
I'm going to sneeze now as well. So, yeah, do not let me forget iron ore, right? We need to talk about iron ore before 7:50 a.m. But I did mention already the UK GDP this morning, and there it is, smashed it out the park. Go on, Rachel. The quarter on quarter, 0.3% versus 0.1 expected. Year on year also beat. The month on month for June also beat. And it's all good news.
Lots of people waking up, especially if you're a business owner, you're probably thinking, doesn't feel that way if you're running a business, and especially if you've got a business that is exposed to the high street.
What if you've got a business exposed to cheap, tacky?
Oh, are you insulting my... I was like, it's 7:36 in the morning. Oh!
2,000 jobs. Claire's goes into administration. What?
No.
So Claire's, it's jewellery, it's like Halloween stuff, is it? Or?
It's like tatty, it's like cheap, accessible kids jewelry, everything from squishy Hello Kitties to things that are called putty.
Right.
But you know, aimed at the cheaper end of the market. And it's a real shame, actually, because I'm not a fan of Claire's per se, but I do think it does have a USP. The problem is the USP is tied to a dying high street in the UK.
Yeah, this is the problem. You don't get this. You don't hear many people ordering online, do you? So that this needs footfall.
Yeah.
In the shopping centres, on the high streets, and it's just not happening, is it?
Exactly. And no matter where you go, you could be like in the high street of Weymouth to the high street of Kingston, Wallington. You'll see that the Claire's might be doing well, but everything else next to it's either shuttered or a charity shop.
Yeah, exactly. And the reason why you see so many charity shops on the high streets is because they don't pay council tax and they don't pay rent for free, so it's just to fill up the shops.
Yeah.
So really sad there. But yeah, 2,000 jobs at risk. Again, another one.
Jimmy Kilby saying good morning all. Selling grain LNG to consortium, the grid, including Centrica. Great news. Good one. We'll have a look at that. Steve Davies, morning. Kate's early today. She's normally on the late step.
Or she's getting in from the night before.
Yes.
Which one is it, Kate? Let us know. Supersonic telling us that 9% of Greg's shares are being shorted. Well, I hope that was a while ago because they'll have done very well.
Yeah, and those of you that heard me talk about Aviva a few months ago, yeah, Aviva is still smashing it. Calling out to James and also to our director today. Well, we've got Dom and Cam. Dom, I hope you heard me talk about Aviva. You were asking me for... Right, good morning, Jugga, and I, Derek, as well.
Right, so what happened in markets yesterday? Well, it was the great rotation. That's right, NVIDIA, they came in, they sold it. And they sold tech overall to buy Russell 2000, to buy the Dow Jones. So you're seeing that money come out of expensive, insane tech valuations, and you're seeing it going into proper businesses that will benefit from rate cuts. And that includes your retailers, doesn't it, Ant?
Big week coming up. The Home Depot as well, and we are seeing, you know, all this rotation as well, you know, in the airline, United, Home Depot, not to do well, resorts, you know, casinos, yeah, whack it up. Here we are. I'll try and zoom in for you, and it's come at a time when, you know, markets are still... I'm going to try and trigger Rich again here. Still, you know, near all-time highs. I know this really annoys Piers as well because he's waiting
No, remember, we're short calls, so all you need is the days to go by and it not to go up.
Yeah, so days to kind of go sideways. So, yeah, and this all feeds into and dovetails nicely the data that we had, that fear that we were going to have this hotter than expected CPI data didn't materialize, did it? It was by the markets, the markets reacted like
the
it
market,
was hotter than
the market ignored the core, which is the one the Fed watches, and decided to go with the headline CPI of 2.7, which was the same as last month. So, you know, you're missing target, but that's all right. You know, it's not going to go up in the future.
What do you make of? I asked Piers this, and he said he's not sure yet. What do you make of all the talk of the numbers being massaged?
Numbers.
Steve saying, has Trump been involved in our GDP figure? See, Steve has been listening. Looks like something we can only dream about.
So, talking about Trump, you have mentioned it, and so we probably need to go on to the big meeting tomorrow. So we've got the Times are talking rubbish this morning, apparently. They're shocking reporting is what the White House have called it. But the Times have gone out with a story that US and Russia is proposing a West Bank style occupation of Ukraine. It will take the current territory that Russia has illegally invaded, and it will draw the line there, the current borders, and then Russia will to occupy it, but Ukraine will still own it, and it will still be part of Ukrainian territory, because the West Bank's worked so well.
Clearly.
That hasn't resulted in any fighting at all, and is as good as a ceasefire.
Yeah.
So that
Peace
is
out.
what to Russia about, and is expected Trump and Putin to talk about tomorrow. But let's get that quote. They say, Anna Kelly says, this is total fake news and sloppy reporting, who clearly has terrible sources. Sorry, is this Trump's daughter? Or clearly has terrible sources. Nothing of the sort was discussed by anyone at any point. Deal done. It's coming out tomorrow, isn't it? That's exactly what's been talked about. Because we know the press secretary of the White House have been caught lying in the past and continue to lie. So is this another diversion in their answer?
I think this is another clever way of, it's called the done deal. That some deal has been done, but actually nothing has changed, right? And Putin, I think, has been very clever by accepting to speak to Trump. He's kind of over backwards during the talk. He's not going to, he's not going to cease anything.
Because that's what I do. I make deals.
It's that he makes deals. It's
Thing away.
We are talking do you call that a pink or a peach color?
Salmon, darling.
That would be the new West Bank, so I guess it's the East Bank.
Oh, the East, yeah.
And the important thing, if you are a Ferexpo shareholder, is the Ferexpo mine is here. Therefore, that's, that would have no impact at all. And peace would be taken as a good thing. And the Times are discussing that this morning. Is now a great time in Ferexpo. And it goes through all the details, but unfortunately it's not as simple as that, because the owner of Ferexpo is in some serious trouble. And that's the other problem. So this article does go into all the details and shows you the share price. It's now 20% of what it was pre-incursion, if that's the right word. And it also goes through this Ukrainian billionaire situation of why Ferexpo might not be as obvious a Russia play or a peace play if there is something comes out.
And this is the timeline for you, trader. I have as much heads up as I can if you are going to be trading this tomorrow, because it is going to be feast. So we have them meeting in the morning, Putin arriving in Alaska, expected in the morning itself. And then we've got mid-morning Trump arriving as well after that. They're going to have, obviously, pictures, late morning historic handshake.
They're going to have a cup of tea, cup of coffee?
Tea, maybe. I don't know what they have in Alaska.
Vodka?
I don't know, salmon croutons or something, I don't know. And then you have this potential Zelensky involvement in the late afternoon. No sources.
They're going to give him a call.
Yeah.
To tell him what's been done.
And he's going to sit there looking, if history repeats itself, he's going to sit there looking like a mug and not be able to say anything. You're not going to see him at all. They're just phoning him to tell him. This is
and then arrange a second deal, and the second deal may involve him.
See, I didn't even think he's going to even get a call, but that's just me.
No, Trump's already confirmed. If there's something comes out of the meeting, he's going to call Zelensky straight away, and then they'll invite him to a second meeting.
Yeah, I don't think anything's going to come out.
So you think the Times is rubbish?
I think it's just going to be we're going to issue maybe a line, but there's not going to be any big. Which is why I've held fast on my. I know some of your trader friends have decided you can't risk it anymore. You're going to get out of the NATO ETF or related.
The defense stocks.
Exactly. Whereas this is my position. This is not any sort of advice whatsoever. This is just my own humble opinion. Either way, they are going to come up with nothing. They might say they have, but they'll come up with nothing. And we will just see this situation continue. Andrew McKelvey and I were talking about this yesterday. If there is any dip at all, especially in stocks like Rheinmetall, then it is buy the dip.
Right, segue quick into iron ore, as we've just had the reminder. So, big drop in iron ore overnight. We saw it down. Let's see, when did it start to drop? It was 3 o'clock this morning. So we had been up as high as 800 a couple of days ago, and now we're down at 776. That's back to where we were on Monday morning, more like Friday's close. So let's have a look at where Rio's was on Friday. And let's see if it's going to... Ange, have you got Rio Tinto?
Yeah, I'm going to put that up right now. Here we are.
So should Rio's open where it was on Friday? We've had the foot. We've had iron ore looked as if it was going to break out, but no longer. So there we go. So £45, is that right?
About 46. Yep.
No, but on Friday?
On Friday.
It was at... it went up from 45 to 60.
Yeah.
And it's now at 46.60. So is Rio's going to open down 2% this morning? And if it doesn't, is there a trading opportunity there? I'm certainly looking at that. And Antofagasta is going to be up 1%, says Singers on the pre-market. So you might see the sector not get hit on the open, and we might have a chance there. So miners are ones to watch this morning. Of course, the FTSE is going to be in focus on the back of those great GDP numbers. That's one to watch there as well. Also affected, BHP also affected.
Yeah, some of the others that we're getting indications, higher early indications. Aviva, Mo, call out to you, up 2%. This is on its first half results. The company also saying on meeting its targets. Centrica also indicated up more than 1%, and we indicated higher as well. We talked about this green LNG deal earlier on with Andrew McKelvey.
further complication to Rios is that it is ex-dividend, along with half of the FTSE this morning. So that is $1.48, which is about £1.10. So it's already going to be down £1.10 from ex-dividend. So then we're talking 44.50.
You do good maths in Scotland.
40.50, having closed at 46.60. So that's going to be really interesting to watch. Other dividends this morning, there are a whole heap of them. You are going to be getting paid if you own the FTSE this morning, because BP goes ex-dividend by 8 cents. Glaxo goes ex-dividend by 16 pennies. Hikma, HSBC is a bit of a smaller one. That's only 10 cents. London Stock Exchange, the sponsors of our opening bell in the future, will go ex-dividend. Melrose will go ex-dividend. Pershing. Pearson, one of the forgotten stocks sometimes in the FTSE. Shell also goes ex-dividend by 35. Unilever by 39 pence. So the FTSE will take a big hit this morning from dividends alone.
So maybe that GDP number might not be offset. Around this time, normally I'm outside getting the upgrades and downgrades for Rich, but I'm in here today, so I can give this to you right now. Porsche, Deutsche Bank. You like a bit of Panamera action, Rich?
No.
What a fancy car.
9/11.
There you
Done.
go. Deutsche Bank cutting the target price to 50 euros from 55. The target price 35 Swissies from 32. And the last notable one is the MTU aero engines. That one's raising the target, Deutsche Bank raising the target price there too, 430 from 425 euros. Otherwise, quite a quiet morning so far.
And I'm going to run and get my order in Rios into the system.
Cool. Right, we are going to, producer Phil, you're going to give us a quick hint. UK or US? US! Does this mean we have a US themed banger coming up? Let's do it!
It's going down. I'm yelling timber. It's trading like it's mid-December. Axel's here with trade of the week. That breakout move. Swing your chart round and round. Boom or bust in London town. Footsie's jumping, aims on fire. That UK stock's what we desire. You better guess, you better sell. Trade live with IG. Ring booth with a wicked grin. Say it looks like we're going in. It's going down. I'm yelling timber. IG live, we're the big spender. Axel's charts got that breakaway. Could be the trade that makes your day. Rich won't stop, he's clicking all day. Short then long, then fade away. Angel smiles, she's playing it cool. Says I watch the moves, let you play the fool. Dimes on coms and cams on shot. Terrence says cut when it's getting hot. Every move on screen from BP's rise to Tesco's green. Ancient's back with a steady style. She's not in the trade, but she's watching the pirates going down. I'm yelling timber. You'll remember footsie dreams and UK pride. Trade live with IG's on your side. We'll ride this wave, we'll set that pace from the city to every trade in space. Skin is the one we're in. We play the game, we roll the dice, but please remember this is not financial advice. From Shell to Rolls and BT lines, UK stocks, yeah, the trade's all mine. It's going down, I'm yelling timber. IG live, you'll remember. Axel's cold, which
That's my favourite yet. That was brilliant.
So impressed. I told producer Phil too that I wanted something that was similar to timber, and he got the word timber. It's jigging along with me. I needed a cowboy hat and a horse.
In a couple of weeks' time, hints about stock.
Pushing the tech.
Little hints about the stock, because that was hard. Did anybody get it? Hamish again.
Was it Hamish? Target. I was close. I was guessing a US stock, and I went for American. Target. You know, with the still expected two, right? Interest rate cuts in the US.
So Hamish hit the bullseye.
Yep. Nice.
Did anybody else get it? Maturing got it after Hamish suggested it. That's as good as getting it. Good stuff. Right. Those orders in. We got 2 minutes to go. Also looking at Anglo-Americano. And we're looking at Antofagasta. Their numbers. Remember, loads of ex-dividends this morning. So do not get worried at stocks being down 1%, 2%. They're ex-dividend.
Yeah.
Apart from Rios, which should be down 1.5%.
Have a look. I'm getting my filters ready.
I started to let some of my... The market did start to feel like it was rolling a little bit.
Yeah.
Not the UK, but in general. So I just wanted to take the book size down a little bit. You know, something to play with. Sold my ASML as well.
Oh, Ronnie's not going to be happy with that.
Yeah, no. Keeping it for the kids.
Yeah. Do you want to hear Andrew's play of the day?
Yes.
Ooh, Carlsberg. It's going to be down, people. I think it's down because of that operating profit guidance. Also, we were talking about this earlier on. Impossible for me to imagine Ange 10 years ago saying that, you know, the products for all these companies would be non-alcohol, alcohol-free beverages.
Core beer is not doing well, is what the CEO just said.
Yeah.
Core beer not doing well for Carlsberg, but their growth areas are, which, as Ange mentioned, doesn't have any alcohol in it.
Ronnie's been drinking too much non-alcoholic soft drinks and brew.
I wonder what other companies could do something that is so against their core business. You know, could I don't know, McDonald's start selling salad? Already have.
Yeah.
Some good ideas there.
Hapag because it's come up with vessel deliveries, global vessel deliveries. For those of you that watch at Space.
For the 20 seconds, the London Stock Exchange is about to open. We've got oil pretty much where it was yesterday, small higher. You see iron ore there, Collapsio, silver down 12 basis points. Copper relatively unchanged. Copper, of course, rallying back off the $4.40 level. Right, let's go into it.
3, 2, 1.
I saw the candles rise. I saw the candles rise at dawn.
Oh, somebody hit the wrong button. Right, remember then, screen up, guys. Lots of dividends today. You're going to see it in the worst performers. It is so many of the big FTSE stocks. Oh, Vodafone. I was almost tempted to let some Vodafone as well at 86.5. But I managed to pull back, hold back. So there they are. BP down 76 basis points. Now, I am trying to short Rio Tinto and Anglo-American. So I do.
You do that, Rich. Just telling you that Carlsberg has uncrossed and Carlsberg is moving down quite rapidly after that first half miss, down around 3% there. Just looking elsewhere, well to the FTSE because now it's completely changed. Aviva, top of the pops there, 2.5%. We've got Rolls-Royce as well. Kate Murphy out there. You still in Rolls-Royce? She's still in Rolls-Royce, do you know?
Look at that, Rios. If we can just change the minors there. Rios straight down to the level we talked about, 44.70. We said for iron ore to look where they would be, it would be 44.50. And there it is, almost straight there, 44.70. Last seen on Friday of last week. BHP only down 1. So, sorry, if you take Rio's dividend out, then that means that it is down about, 110, so that's 2.5, 1.7. So Rio's down 1.7%, BHP down 1.1, Anglo-American only down 83 basis points. So perhaps we'll see some catch-up from Anglo's on the way down. But Glencore, of course, not an iron ore producer, it gets away with it. Going back towards the £3 level.
Interestingly enough, do you have a position on Antos?
No.
Because it looks like investors either taking profit or seeing something else on the headlines at the moment, because Anto posted a nearly 60% rise in core earnings in the first half. This is news that came out about an hour ago. Also, it had positive news from its Los Palambres project. So still looking out there, trader friends, to see what's causing its shares to fall 1% there.
Right, Glaxo, as we said, ex-dividend, HSBC ex-div, Shell ex-div, all there. Really losing. They're just paying you out, paying out your interest. Then we see, Unilever again, that's another one. So Anglo's is probably the biggest loser on the day, along with Aberdeen. Is Aberdeen ex-dividend or is Aberdeen just down?
Let's see, while you're
I think
checking that.
Aberdeen is just down. Yeah. And then we've got Persimmon, Pearson. But what's up, Ange?
What's up? I can tell you what's down. That's much easier to tell you. ThyssenKrupp, look at that chart there. Down more than 7%, actually more now, down almost 8% there. This is after its results. So that is quite a big move there. Also downgraded, disappointed on its outlook. Sales will now fall 5 to 7% during its fiscal year. So negative news there.
In the elevator down. Right, back to the UK, we got Rolls-Royce. There it is, up, we're back towards highs, towards the £11 level. And Centrica up 1.5%. We don't see Centrica.
Yeah.
BAE as well, you're going to be happy there, Ange. They are liking the West Bank story.
Yeah, so my humble opinion, Rich, as you know, is that Friday, or even if we don't get something out of Friday in Alaska, the fact of the matter is Ukraine and the rest of Europe are still going to have to up their weaponry, drones, whatever.
Oh, absolutely,
right?
yeah, they've got to restock.
Yeah, rearmament 2030. Look it up, trader friends. If Sachs has already, so look it up. So whatever.
They're not in any other significant moves. RWE is down 2.6, Porsche's down 80 basis points. Kering down 60, but at $216. Then we've got Airbus up 70 basis points. Schneider, Ryanair, SocGen, and BNP.
Nice. Do you want to hear another don't want to be a negative Nigel, but I can tell you all the downers today.
Is Nancy on holiday?
HelloFresh. Have you ever used HelloFresh? 'Cause I know you like ordering deliveries to your house.
That could actually been one of my best shorts of all time.
Did you?
Because-
Why didn't you short it? You were telling
No,
me
I
about
d- I
this.
did.
Oh, you did. Great.
And that was long before I started here. But we were bringing HelloFresh into the house, and we would take. I think we probably the menu cards and cookbook.
Yeah.
I didn't need HelloFresh anymore, so discounted me the recipes, and then I go to the shops and buy stuff myself. The whole business model just doesn't make any sense.
Knocked on my door, and I said, "Love the concept." 8 people, and then they looked at me. What's your smallest? Look at that.
The daily charge.
Even if you go
No, back to like
to
short in the world.
the biggest short.
Oh yeah, absolutely. Yeah.
So HelloFresh, this is because it continues to have a rough ride and continues and is on track, if it continues in this vein, on track for its worst day this March.
The business model just does not make sense.
No. And I don't think they have moved with the times as well. They should be partnering up with, don't keep fresh.
Hello
Phil says.
Frozen is
Hello
what it should
Frozen.
be called.
Yeah, and they're not also moving with the times and giving people sort of more cost-effective options. High real fuel inflation, still high out there. So yeah, other than that, the reinsurers also not having a good day. Swiss. And let's have a look. Should we go cross over to France, darling?
What would you like to see in France?
You talked about currying already, but let's have a look.
So, yeah, let's go there. And yeah, on the down moves in France, you've got not too much else. Stellantis, €8.20 that's settled at there, and Air France 13.70. Right, Ange, before we leave the studio for the last time together,
Yes.
talk us through what's been your favourite in the last 11 months, because we are coming up to our anniversary as well.
Yeah. I can't believe we're coming out to it. It feels like, it's been such a breeze and having you here and doing new stuff for our trader friends every single day and rolling with it. It feels like it hasn't been that long, but how many had already?
I think we're about 220.
Wow. My favorite moment is when you carried, it was quite recent, you carried a tree in here.
Yeah.
You
Actually,
couldn't
let's have a look.
see.
How smart web.
What you couldn't see was that I was midway through the door, so I could see producer Phil's deadpan look.
They had no idea why I was bringing a tree into the studio. Right, SWC 205 to 215. So boring, no change. The vol's gone,
Yeah.
of it, which is good in some respects, because it's becoming a more valuation's not all over the place.
Less volatile.
Yeah.
How about you? What's your favorite moment?
No, Donny one. Sorry, no, Ange is not leaving. Don't you worry. We're leaving this. No more as of tomorrow morning at about 9. The lights are going off for the last time. The cameras, we are going to throw out the window, and we get cameras, brand new lighting. Because just in case you haven't noticed, this isn't a real background.
Green. It's all green here.
So we are, we're
Everything's
getting.
green.
Thank you very much to IG for has signed the checkbook.
Nice.
And the cameras are ordered. And yeah. Doing.
We are going to be plugging in remotely, testing out the kit whilst this is all being gutted. Phil and the crew have already set gallery outside of here because that's also.
You're worrying me. Are you still on? Are we still on air?
Still on air. We're still on air. Don't worry, guys. Don't worry. And also, other than Brion, thank you, Brion, for signing that check. We also have to thank our most important people who are our trader friends who made it possible with your likes and subscribes.
It was literally, if you didn't like and subscribe, then we weren't getting new cameras and lights. So, and
no haircut for Rich.
well, no, the great thing, the new cameras have got a filter. There, Andrew McKelvey beat me to it. Better cameras with a sharper focus, a good idea.
That's okay.
He literally on that take off about 5 years.
More like 20 for me. Thank you so much, guys. Mature, and also we're in danger of losing our.
Very true.
Yeah. But it will be exciting. We will still be here. Rich and I will still be bright-eyed every morning. We won't leave you, and then we'll be back with this new studio.
So next week I will be coming to you live from Scotland.
And I might be from sunny Dorset.
So yeah, we'll. But yes, first of all, we'll see you tomorrow because tomorrow, of course, a huge day of Fantasy Premier League, and there is your link in the chat for the Trade Live with IG Fantasy Football League. I expect you all to be joining there. Very excited to win that.
Right, we got Axel coming up next, waiting in the wings. I can hear him, so stay right there, get your coffee, and Axel is going to come in.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto, live on Trade Live with IG.
Okay, guys, before I use this, the mind, the cash return. It was about the mind. Become full. Realize greatness. Okay, minds are ready. Time to go. Hey, come on, Pat. Come on. Oi! Oh, you're not going to get better than cash returns.
Take bold action. A dangerous downward spiral. At the same time, the UK is stuck in a damaging savings-first mindset with far too few people investing to build wealth for the long term. With our Save Our Stock Market campaign, we're calling on the government to deliver the urgent policy changes our stock market badly needs, from scrapping stamp duty on UK shares to encouraging a shift away from stagnant cash savings. Incentives to get people backing British firms. And to show we're putting our money where our mouth is, we'll be offering every new customer who joins IG across July and August a free UK share bundle. For too long, policymakers have been paralysed by the desire to keep everyone Time for working groups is over. This is about getting more before it's too late. You can read more about IG's SOS and free UK on our website.
We're going to do a very quick, technically speaking, because, oh dear, I've lost money while you've been on holiday, Mr. Rudolph.
Oh, sorry to hear that.
So we're going to dive right in. The Nikkei 225 on the daily chart. Let's have a look at this one.
Yeah, if you could just zoom out to the last 2 bars, basically, that'd be great, Rich, because I had a client yesterday who unfortunately has been short and basically has been suffering. Ask me, can this thing come off? Basically, it is starting to very short term, as we can see here, with investors taking some money off the table ahead of the weekend. But the trend is clearly up, and we've made new all-time highs. It's been very, very strong. We went above 43,000 on the Nikkei, all of which is very bullish. If you go on the 15-minute chart, what I found really interesting yesterday, 3 higher highs on the 15-minute chart. But if you look at the bottom of the chart, the RSI, we had lower highs accompanying these higher highs on the left-hand side of your chart. And basically that was telling me it's divergence, and the odds were pretty high that we could see some sort of return to at least short-term support. But the interesting thing now is, can you see that side just pointing at? That was the first support area in the Asian session. Perhaps we could see a short or perhaps even a longer term reversal happening here. We'll have to see what the chart will look like and whether we will then have perhaps what is called the bearish engulfing pattern on the Nikkei 225 futures chart, for example, on the from a daily perspective, is still pointing higher. This be a minor correction in a very strong uptrend, but I don't know. I'm keeping my eyes peeled on the markets at the moment. Everybody else is.
Yeah. Now let's go into that then. 500. Know what you think, because this is very dear to my heart at the moment, Axel. I'll daily to
Yeah, I mean, basically what you beginning of August was also negative divergence, and I was on holiday then, but I thought we could come back to that support area, which is what we did. We basically bounced off since then have risen again to all-time high. So to be quite honest with you, Rich, and this you might not want to hear, for the time being, it's bullish. I mean, it keeps on rising. I know people love to sell into a bullish market and thinking, oh, it can't go any higher, but it can always go higher than you think.
Yeah.
And even if you think fundamentally it doesn't make sense, right now, the majority of investors seem to think it does, because the market keeps seeing buyers and it pushes higher. I'm quite interested in looking at these markets in detail. People are on holiday, there is less volume, and quite often you do see movements which can lead to quite a bit of volatility in time. And also you do tend to see corrections in September and October of each year, depending on what the market does beforehand. But this is a sort of typical scenario I've seen many times in the last 40 years or whatever. I looked at the markets, and I wouldn't be surprised if, and this is a big if we were today, maybe the next week, we're starting to sort of drift off. If that can then turn into something that is a bit more dramatic. But right now, that's higher. So as long as we stay above the early August lows, from a technical perspective, from a medium-term point of view, we are still bullish.
Right. So it's that 6,200 to watch.
Because if you look at that level, that's I mean, if you go to the left,
Yeah,
you can
it's
see
a
all
big
these
level.
lows there. That's really good support. That's the last reaction low. You had a strong rally off there. And as long as that holds, the trend's your friend. Now, you need to follow the trend, not what you think the market's going to do, because the price action itself is telling you what it is actually doing about you,
Yeah.
or I, or anyone.
Yeah. So, right, let's go into a theoretical. Say we get up to 65.20, 6,520. Like you say, the momentum kind of fades a little bit, and it starts to roll. Thing from the chart previously that suggests what the downside could be if it goes down through that 6,250 level. The reason I ask is because I probably want to sell some puts somewhere, and I want to sell them at a level where obviously the market could drop to, but might find support at that level.
Well, that will very much depend on the fundamentals, because basically, this market has been driven by the institutional investors actually think the market's completely overvalued. They had to then sort of, but the strong rally from the has mainly been by retail investors who were right, and then institutional followed. But at the moment, according to the latest Bank of America survey, fund managers, 91%, and this is, I think, a record high, 91% of fund managers believe that the market is overvalued in the US. Yet they keep buying it. Probably because of forced to buy it. And we've got this huge concentration in just a few stocks. But if you look, and that's why I wrote an article about other cracks appearing in the US economy yesterday, which you can find on the IG website. I looked at corporate bankruptcies, and nobody talks about this, but we had 446, I think, large US companies filed for bankruptcy in the months of this year.
Wow.
That's the highest year to date since 15 years ago, I believe. And it exceeds the totals for 2021 and 2022. So that's telling me perhaps there are some cracks showing. And also, if you look at the small businesses, there are about 230 small businesses in the US, and they face import costs now because of the tariffs of about $202 billion. That's no small amount. And let's not forget that they don't have the structure in place to deal with all this complexity to do with tariffs, etc. They might not have the the resources with regards to compliance and all the rest of it to deal with all of this. And basically, my battery on my laptop is running low. I've just seen, so let me just bear with me for a second.
No problem. I'll just talk about what we've seen in the last few days in the Russell 2000. Russell 2000 having a huge upsurge now, of course, because we're going to get rate cuts in the US. But what we're talking about there is the smaller companies, and the smaller companies are represented in this Russell 2000. That's not got any of the Mag 7, of course. It's the real America. Is, yeah, that's wonderful. You've got rate cuts coming through, and that will help. But could it be too late? Because, you've got the Russell 2000 Hopezium, the 4% move in the last 2 days. But if we see that start to come off, and we see the economy, the jobs lose, more job losses, and real slowing, then we've got this going to come off. Forget the Mag 7, obviously does its own thing. But real America and the Dow Jones, then you see weakness there. Now, we have lost Axel, I'm afraid, but that allows me to have a little rant about what we saw yesterday. And that was, of course, bullish. You heard it drove Piers yesterday to swearing live on air because he couldn't believe that we were actually IPOing a stock bullish on the New York Stock Exchange. Now, what happened when it did IPO Well, of course, it started up in above $, having IPO'd at 33, and the stock came off. Let me try and get rid of the RSI there, because I want you to see this in all its glory. And we'll go to a 10-minute chart. Is that going to be better? It's really hard when you get a new IPO. Of course, you can't really see the GIP of the day very well. So let's see if I can get this on a chart where you get anything. No, that's not going to show it. So yeah, the charts just don't like when it's a brand new stock. But what you can see is it opened above $100 yesterday on the New York Stock Exchange. Everybody gets about these IPOs. We've seen what's happened in the few weeks. The stocks have gone up 100%, 250%. If you are buying stocks on the IPO without knowing what they do, without looking at the accounts of looking at the valuation, you're not investing. You are not even trading. You're gambling. And the people who were buying this stock at over $100 on the open yesterday, you deserve to lose money because you haven't done any work. You're just getting caught up in the FOMO. And this program is all about getting people to stop doing that, to stop losing money, to try and get discipline into your trading. This stock is at $8, right? So if you've bought it at 100 on the open, 5 hours later, you've lost 33% of your money. That is not what we're here for, right? We're trying to teach investing discipline. We're trying to teach trading discipline. And yeah, these IPOs that everybody is love to get involved in, please do not other than sticking 20 quid on the 3 o'clock at Southall. Right, and Julian will be back shortly, but enjoy the next episode of the podcast, The Art of Investing, with my good friends, Mr. CJ Fillingham and Mark Holden. And yeah, we'll see you tomorrow for the last day in this studio.
Okay guys, before I teach you how to use this, I have to teach you how to use this, the mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready, time to go. Hey, come on Pat, come on. Cash returns, come on. Oi! Oh, you're not going to get better than cash return. The cash returns.
Today we're here because we've recently launched our Save Our Stock Market campaign. We just want to raise awareness of cash returns that everyone is getting with their cash ISAs. What we want to do is raise awareness for the great UK stocks and help revive the UK.
There's a lot of bad feeling in the stock market, and it's really negating people's view on the UK market as a whole. There's some great companies. If we just on people getting behind the UK stock market, then we can start to get the interest, and it's really that awareness, and ideally we'd like to take it to the government. Believe in the chance of people saving, but more that you get higher returns, as much as 7 times historically in investing, that you can from not seeing people. And it's about people to understand the benefits of investing and the limitations of
We're watching a crisis unfold in the UK and we need to take bold action. Our stock market, once the envy of the world, is in a dangerous downward spiral. At the same time, first mindset with far too few people investing to build wealth for the long term. With our Save Our Stock Market campaign, we're calling on the government to deliver the urgent policies our stock market badly needs. From scrapping stamp duty on UK shares to encouraging a shift away from stagnant cash savings and using incentive penalties to get people backing British firms. We're putting our money where our mouth is. We'll be offering every new Coins IG across July and August a free UK share bundle. For too long, policymakers have been paralysed by the desire to keep everyone happy. But the time for working groups is over. This is about getting more Brits investing while saving a strategic national asset before it's too late. You can read more about IG's SOS campaign and free UK share offer on our website.
Hey, trader friends, and we have that promised special treat for you in the studio with me, especially because all of you were asking for equity specialist is Julian Wheeler from Capital. Welcome. Just quickly tell our clients. Fantastic. It's an interesting of the people that we speak to. When is this correction? When is this summer correction? Or has seasonality been thrown out of the window?
Yeah, well, I think that's exactly that. In August. We're not through there, so it could still happen. But what we don't normally have is a 20% decline in the S&P from mid-February to mid-April.
Yes.
So this year was rather different.
Tariff tantrum.
Tariff tantrum was ready for that. Everyone was in February, and they moved to underweight by April.
So what happened?
Well, what happens now is that while everybody's expecting a correction, the bar got set so low. It's like imagine a sort of high jump, which I do. If you set my bar at 3.5 feet, after April, and everybody's saying, can't give guidance, don't know what's going to happen, so they had a free pass. So there's been no disappointments, no reason for the market to go down.
S&P 500 higher, green bars outnumbering the red bars there.
Technical trading says that's going higher. There's nothing saying every dip has been bought. You can volume, big heavy volume selling, and then we've crept up. And this, of course, is the worry slightly, is that it's very thin out there. August is traditionally thin. But what's interesting is that retail is now making up a larger percentage of the market than I think it has done for some time.
Now, this is super interesting because we were talking yesterday with peers from Mako, our trader friends. You guys heard this here too. The market, when retail, and we're trying to find this number. I know you've got this especially for us because I called you yesterday. Julian, please get this for our trader friends here because all the apps as well, we're laughing about this, but it's actually not a joke. And we've seen this in the US on their apps with the colors. Also, passive investing is growing.
About 20.
And where is this figure that's 20%?
Well, that's it's open to question. You base on that. You can only base that on the amount of money. Places like retail accounts. These accounts will trade on margin as well. So it means that during August, when most institutional fund managers are sort of quietly away in, I don't know, the Hamptons or wherever else they're going to be, retail's taken a bigger share, according to one of the trading desks I speak to. One of the over 20% of the volume right now. And to sell. That's the big difference.
They just sit on it.
Well, not only are they on it, but it's not their job line, right? So if their size of position, if they get it wrong and want to change their mind, click. They can sell, takes 10 seconds, less.
Less.
Now, you're an institution, you own 5 million shares. I don't know, let's say United Health. It's taken months for everybody to get out of that. It's gone down and down and down. Retail investor would say, don't like that, gone. So they are fearless because they can change their mind and exit quickly. The institution can't do that.
So how do we these, markets? Because clearly, if seasonality is out of the window, we've got Trump tweeting left, right, and center. You not believe it, trader friends, but it's true. Ask Julie, my guess. I almost have like a, if you don't hear from Ange, the night before, sometimes they do now, because it means something has happened over from me. I mean, these aren't normal times.
No, Trump has made this market more of a day-by-day sort of almost game show. But the problem is that he's a bit like the little boy who cried wolf. He frightened everybody in April, absolutely scared the bejesus out of everybody with his tariff numbers. But of course, that's nonsense. It's not happening. Would turn around and that the EU was definitely in America's favor. So he could turn around and say, well,
And chiming in there on the chat right here. This is great because we're going to get Julian, first time in the studio, and he. So I know you can talk about shorting the US market.
I do short stocks. I see he's picked up Palantir and Nvidia. Palantir is the most expensive stock in the market, but it's also doing incredibly well. And I would give him, I'm definitely not shorting Palantir. Very simple reason. It was the same question we were asked about Tesla a few years ago. Tesla was crazily, stupidly overpriced. Doing well. Haven't disappointed. They put up better earnings than expectations, so they have not. It's a big retail name. It's shaken out. Guess what? So's Tesla. Big retail name. Tesla is a short, fundamentally under.
Yeah.
But I do short, yes. Expensive. That's the thing. Want something that's actually getting worse. That's a short.
Yeah, also a household name now.
Well, household name, retail owned, name, but it's the world leader. Bad companies out there to short.
Talked about Palantir, about how it is, expensive, but it's still good at what it does. You like another one, don't you? You like another. Yes.
Yes. Okay. So Cloudflare valuation metric is incredibly cheap. Is far less known, but it's creeping up there. It's doubled it's doubled off.
So this is a really nice chart from a technical point of view.
Now look, that is a hair. When the market comes down, it will get clocked. Performed and performed and performed. And if you take that chart back far enough, you'll see that it's now gone through its 2021 high, which is a bit of a key. It went right down. There you go. The peak of the market then. So it's on the verge. No, that's 220. It's on the verge of going through there. Cloudflare is, I call it the fourth cloud. So you've got Amazon, Microsoft, and Google. Cloudflare is number 4. But significantly, it was engineered and architected differently. So without going into too much detail, it's a mouse. It does compute, it's infrastructure, it's storage, but it's just more efficient. 75 billion worth of cloud revenue, Azure revenue. Now, which bit's what? They're not going to tell us everything. The 75 billion. So, Cloudflare's revenue at the moment is 2 billion. All they have to start doing is share pieces. They don't have to win a piece of it. Massively growing market. I see that share going a lot higher. Oh, what's more, at 70 billion, it's one of the largest companies not in the S&P 500.
Love it.
One day.
Added.
That's a little Brucey bonus. That's that'll happen sometime. But we don't, I'm not for that reason. But
Love it, tech, and just up my street, you won. To GLP-1, but Novo has been hit recently because of competition, and also got all these pill versions coming on. Interestingly enough, I found out that the pill version years and years and years ago, but they don't really nation, do they?
No, they probably don't. No.
But Novo and Eli, very interesting to me because I have both.
Okay, well, I prefer Eli to Novo for the simple reason that it is not just a one-trick pony. With apologies to Novo, but they are living and dying on the back of GLP-1s. Lilly has a whole load of other things as well. A good cancer drug coming through called Verzencio. It has all sorts of things. Lilly's had a nice sell-off, there you go, which would say I would put it in the buy zone now. The reason for that last sell-off was that they have an oral pill that they're trying to bring through, which has a...
Give us the name because I can't pronounce it.
It's really difficult. It's called orforglipron. Okay. Yeah, don't ask me to do that again. I file.
Sounds like awful diphthong.
There you go. Orforglipron is there. They produced the result. It works. It just wasn't any better than anything they've got. So it's like, what have you done for me lately? What that means is that's opened the door for another small, which I also own and have told the clients to. It's called Viking.
Right, Viking Therapeutics. Yes.
VKTX. It is, now look, this is harem-scarum stuff, but you can see that moved in the last week was from the day Lilly announced that its drug hadn't done so well. So that's a move from 32 to 40. So we've had a 20% move in the last week. Now, crazy, but if they're in phase 3 of this oral, if it works, that company won't be around for long. It will be snapped up by somebody, and it's a market cap of about 2.5, 3 billion, so it's tiny. Someone like who's got large war chests.
Yeah,
AstraZeneca, all these companies got plenty of cash, not much in their pipeline. This thing works. So, it's a bit of a Hail Mary, but they are in the right space.
Right, Andrew McKelvey coming online as well. You know that I like energy, the energy play as well. So, yeah, Central Grid, some of the Divi plays. And Andrew McKelvey is seeing your question there about nVent. Looking at that too. I did ask Piers yesterday because I think Andrew's just got into nVent a month in perhaps, and Piers was saying this stock for another for 12 months plus. So that would mean about 11 more months for you, Andrew McKelvey. But
Pelican's asking about CoreWeave.
Yes.
I don't like CoreWeave. I don't like CoreWeave because it's crazy expensive. Its business is all tied up with OpenAI. The trouble with CoreWeave is it's owned by NVIDIA, it makes loans to NVIDIA. It's almost like a channel for NVIDIA. I don't. Now, very clear, paid 50 and you went to 150. Interestingly, I can't even short it. So it must be heavily shorted. As in, my machine said, you cannot short this stock.
Computer says no.
Computer says no. Which is actually when something can't be shorted, that means probably too many people are short. If people are short, you don't want to be. So, but I don't fundamentally see why I want to own CoreWeave. I think there are some fairly other hedge stocks that are slightly more transparent.
Yes. And if you're going to go on that is effectively a play on NVIDIA, it might as well be in NVIDIA.
Well, NVIDIA's not expensive. I mean, it really isn't expensive. It's much more. Remember, NVIDIA's done pretty much nothing for the last 14 months. It got to 150 last July, and we're at 180 today. You know, in stock terms, that's really not a lot.
And I think it's expensive given they've gone from talking about petaflops to exflops. So
I mean, you know. If you're a Prime member, you can now have delivery, same day delivery. Well, obviously, the market initially went, oh, that's good. And they took Amazon up a little bit yesterday. What they really did was they smashed the competitors. So Kroger went down a lot. The ones that really got hit were the delivery companies. It is a business that I think is pretty rubbish anyway. You know, afraid to say. So Instacart, DoorDash, Uber, you know, Uber, obviously Uber's wider, got a bigger set. But so Instacart got the biggest hit. If Amazon's going to do home deliveries, that's going to cost them. It's not good for UPS either. It's not good for FedEx. It's going to be more of their delivery. So it's a big change. You know, these are my instant, because it was only announced yesterday. But Amazon seems to be losing share in the cloud business. It's not growing as fast as the others. Google, Microsoft all put up much better numbers this quarter than Amazon did.
it would
And
also,
Walmart's back in,
Yes.
in retail. We'll get more from Walmart. You asked about this correction. We didn't get a correction because what we've had is the tech earnings. Tech earnings are great. Walmart will give us more of a clue about the consumer next week.
Fantastic. And just taking a look at Walmart as well to see whether there was a reaction after the Amazon news. The reason why I'm interested is because when I'm in the States, I do take time to go to all these places. I never buy anything. I'm just stood there watching. I know it sounds strange, right? Maybe trainers. Trainers are really cheap there. So I'm wearing a pair of trainers that I picked. I always pick up about 3 pairs because it's just so cheap there, right?
Yep.
Your Targets. Your
Used to be. Getting better now. Our pound actually buys something now.
Well, it's more like the dollar is
Well, the dollar's
beaten
gone down, so now 135. It becomes a bit more.
Yeah, so I come back with minimum 3 pairs of trainers because it's cheap there. But you know what's
There's
interesting?
Walmart yesterday, that red bar.
Yeah, and that makes sense because Walmart. Have you heard about their premium delivery services? I can't imagine anything more horrific because there are more options than I thought possible. One is you pay an amount for them to bring it to your house. Then there's another more expensive option where they get some smart fob, so they put it in your garage. Then there's an even more expensive option where they bring it into your house and they put it in your fridge or where you...
You know what's coming next.
There's one more, and I just thought, how lazy can you be, people? How lazy can you be? They arrange it on your worktop.
Oh.
And you know, if you can't tell them where to put it, they just lay it out so you know where everything is.
So nice. Oh, the next thing is, that's going to be a big business. I haven't worked out the exact play on it yet. Drones.
Ah, so they put it in your garden or just drop it.
The drone will arrive. You'll hover above. This could be in, you know, slightly rural America, where everyone has a yard or garden, whatever. So the thing won't go in your house, but it won't have to. But it will be able to leave. It'll sort of come down. The drone will hover above the garden, and then it will just come down on like a little parachute, drop it down, and then you'll be there to take it. And if you're not there to take it, it'll just drop the thing outside.
San Francisco, someone would have stolen it within 2 seconds. It is really bad out there, really bad.
I haven't been there for a long time, but I hear it's not as good as it used to be. A lot of the shops in downtown had to close because there was just what they call shrink.
Yes.
You know about shrink, obviously.
Yeah.
Shrink, basically, people just walking in the store, walking off with it. Yeah, it's bad.
Right, so back to Walmart and how about Home Depot?
Well, Home Depot is great. So Home Depot's it's a fantastic company, right? So you've just got to get the housing cycle. Now, the housing cycle, there are plenty of ways to go on housing cycle, but we need still moved. When the CPI number came out on Tuesday, all the housing-related stocks moved. I think I've got some better names than Home Depot.
Yeah. This is exciting stuff because we have all sessions in about 8 minutes time, which I'm hoping you will join me for.
Mm-hmm.
All sessions is one of the best products here at IG because you get to take ahead of the cash open. So and all the most liquid US stocks you can trade here on the IG platform. And what is also amazing is that, if there are any names that you like, please call them out. Recently, we've been seeing a strong opens. You get to ring a bell as well. C is going to sponsor. Just had sign off. So, Julian, it's a very special moment for you. Our friends know as well because tomorrow, after our last show in here, we've had about 255 shows. This whole place is going to be ripped out, and expenditure has been signed off to make this all bright, shiny.
Right, so a bit like Trump and Powell, you have to
Trump.
got someone come around to check on your refurb cost.
Yeah. So thank you very much to all our trader friends who have made that possible, because it's only because of your like and sharing your great
You managed, right?
Yeah. So any questions for Julian, please put them here and we'll get him to answer it with us on all sessions. We come right back.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting So if you think the market's going up, you buy. If you think it's going to go down, sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
You how to use this, teach you how to use this. The mind. The cash return wasn't all about speed, it wasn't all about, it was about the mind. Because greatness. Okay, minds are ready. Time to go. Hey. Come on, Pat. Come on. Turns, come on. Oi! Oh, you're not going to get better than cash returns. The cash returns.
Counting down to the all sessions opening bell with Julian Wheeler, who has kindly agreed to stay. We have a question from Blue Dash. Good morning, Blue Dash.
Morning. What are your thoughts on Pepsi? Turn it right. I think I like the sector at this point more than I do Pepsi. But I think you're right. I mean, that looks a pretty good bottom. If you're technical, looks a bit overbought short term, but looks like the bottom is in. The problem with Pepsi is that they've taken so much in pricing, they haven't reset like the rest of them. And Pepsi is an awful lot more expensive than, say, some of the other ones in that. Because Kraft on about 9 times earnings now. I mean, 9 or 10 times earnings. Pepsi's still in the 20s. And that's because Kraft has been, it's been such a disaster. The reason is I think I've got a catalyst. Berkshire, largest shareholder, Berkshire Hathaway is fed up and they are talking about restructuring. Splitting this thing up. Kellogg did it very just about a year and a half ago, split the company into 2 pieces, both of which have now been acquired. One by Mars and the other by another private equity group. So it sells the salt and sugar, and this isn't me, I never getting all moralistic, but the healthcare, RF Kennedy, and the whole movement, soda, the SNAP payments, sort of, you know, like food stamps, they're going to ban soda and stuff from that. So that's a lot of that. Really, you know, that's bad for Pepsi because it's more a bigger part of.
Because you know, I am watching that like a hawk, because that will affect the GLP-1 space as well. And trader friends, if you wonder what analysts look out for, because I am also an analyst, I look and you can buy this data that crop up at presses and meetings with other analysts. And the last 5 years going to affect the likes of McDonald's, right? Your cigarette sin stocks. There's something about GLP-1 that they don't understand quite yet, but early data shows that it curbs risk-taking. So take a look at that. Yes, I will send you the data. We have 5 seconds to the bell. I'm going to pass this to you. You're going to ring it. 2, ring it. Just knock it. Yep. There we are. And well done, Julian. His debut. The London all sessions. Right, we are taking a look at some of the gainers first whilst it's shaking up. Beyond Meat there, up 3.5%, but it's a very volatile stock. Usually, United Health is 2%.
Okay.
Some of the crypto names there also bouncing back. The Mara Holdings, MicroStrategy is down 0.75% there. Upstart and Virgin also higher there. Any of those?
So you've got a lot of crypto stuff there. I don't know if crypto's base, MicroStrategy.
I think Bitcoin recently touched.
Okay, so that would explain. News on any of those, is there?
No, Nova, notice these are the ADRs up 8%. Now
that's probably following Lily's stronger day yesterday.
Yeah. Losers list now.
Losers, right.
Yeah. Best Buy down 2%.
Down 2%.
Also got Pinto retail stock, Chinese one down around 8%.
Yep.
Snowflake also down a bit.
Snowflake down a little bit. Snowflake is a great company. MongoDB.
It's more.
MongoDB is MongoDB had, especially for a web-based application. So you can imagine during COVID and everything moved, it had this huge, and the worry has go through a period of adjusting from the related boom in the economy. Well, it looks like their database is very relevant for an AI transactional database. Quite complex, but they will compete. That's down. I think the market's got that wrong. If I'm right, that stock's going a lot higher.
Right. And
one good quarter last time. You have to wait for something. Last quarter, they said they had the biggest new customer sign up in 6 years. Oh, back to the highs there, 350.
Nice. Now, this is not... we've got... Good morning, Mo. Welcome, welcome. I know you like plays. Helican asking whether you can talk about Hood, Robin Hood.
The more volatility, the more action in the stock market, the better for Robin Hood. To valuation leadership, questionable. Again, it's a momentum stock. I'm sure who. It's not a reason to sell, because how do I know what's expensive? This was the thing about saying why 91, why the market's not coming down. 1% of investors, according to the Bank of America poll day before yesterday, say the US is overvalued. What that means is they're out, they're
in their bear caves crying.
They are in their bear caves crying. Yes.
Let's have a look at this as well, because from a technical viewpoint, it is, as Julian says, all above moving averages. Let's also have a check in on the RSI there for you, if we may. And for the friends that use this often, all you have to do, or if you're not au fait with this, just go to the on the left-hand side, RSI. Looking overbought by any stretch at the moment.
I mean, I would say, look, if you're a trader and you've been long that, very well done, and you can see how moving average every time it comes back to it. What is that, 50 day? Oh, looks like it. That one, I mean, roughly 50 day or 20 day. The one up close to it.
Up close to it, that is the...
So clearly, there are people watching that. They're buying it every time it gets there. So you're right there now. On the left there. If it breaks it, then you start a correction.
Let's go to the left, because technicians always say, let's to the left, to the left. Let's move to the left.
There's the left. There's the left. Well, that was a funk, but we're back in. I think as well, don't they? So they're part of the whole crypto, which has allowed that as another benefit to them as well.
Yes.
So all these trading platforms have done incredibly well.
They also have an app that...
Those colours are?
Because to me, yellow lines are
Yellow.
clear.
My father was colourblind and yellow was his favourite.
Everyone gets really excited when they see a nightclub with all the wonderful light that comes from underneath the cocktail bar.
Right.
I'll see 5 Julians.
Okay, that's probably 5 times trouble, isn't it?
5 times trouble. There you go, Mo. Good on you. You've been in Robin Hood and for some time, I believe. Also, been asking about MP materials.
MP materials.
One I am...
I don't know MP.
there was something out today. MP materials. It is all sessions, up 0.2%. Let's have a look at that. MP materials. Yes, it's a miner. It's a rare earth
Rare earth.
miner.
Oh, yes, MP material, right.
Market cap of around 13
billion. Right, so it's rare earth. However this pans out, have another 90 my way of thinking. They're probably saying, no, you have another 90 days to come around to our way of thinking. It would appear that China has enough of a strong hand here with the rare earths. So, domestic earth concentrate production jumps 45%. Well, that's,
beginning of August. But bear in mind as well, there is a chart there. There are huge numbers of yet undiscovered deposits. They're trying to find all these deposits in places like Indonesia. So I would say keep an eye. I don't really trade the space because I just think it's, keep to what you know. But if you do, they say about production in places like obviously places like Alaska and places like if you are interested in this place, I highly recommend in this play you go to the Greenland Investment Summit every year.
Obviously. Yeah.
Of course, in London. Where else? The Mongolian Investment Summit.
Okay, I mean, there's no way
Yeah.
just because it's screamingly overbought, miles away from its moving average. I think somebody's got there before you.
Yes.
I think.
The party's already
The party arriving when most people are 5 cocktails down the road. So I reckon at best, or at worst, you'll be able to buy the stock at the same price in about 6 months' time.
There you go. No, there you go. You heard it here first. MP Apple invest 200 million and thank you very much. I hope all of you trader friends really enjoyed that. Do hit the like and subscribe button, especially to get Julian back with us. And we're going to have man or woman or Ange versus machine coming up next. So do stay tuned for that.
In the last talked about earnings per share, or EPS, using pizza slices to explain how much you ratio is valuation. But what do I mean by valuation is essentially the price compared to what you get in return. Is it worth it? Whether you're buying a car or a house or shares in a company, valuation helps you decide. In the stock market, what you're getting is a share of the company's profits. The PE ratio tells us how much investors are willing to pay today for those earnings. But why is this so important? Because it helps us compare companies and decide whether an investment looks cheap or expensive relative to others. Now, let's take a British construction company, for example. This one block is the company's EPS, and that is £1 per share. When you're buying a share, you're buying into the future profits of that company. To avoid overpaying, you need to know how expensive the price is. Now, just because they love the company, without paying attention to the price they're actually paying. And it might sound crazy, but a share price alone doesn't tell you how expensive a stock is. The valuation does. Now, this is the important part to get. If the EPS is £1, then how many blocks of earnings am I willing to pay for a share? What's the right price? Is it 12 times or £30? Or if our construction company's PE ratio is 14, that means investors are paying 14 times the to buy a share in the company. So the share price is 14 times or 14 blocks built on top of each other. Now, why have I chosen 14 times? Well, that's actually the price of the FTSE 100. Adding all the profits together of the top 100 British companies and then dividing them by the number of shares, we can say the FTSE 100 is trading on a P of around 14 times 2024 earnings. Now that looks fairly cheap relative to its own historic PE of times. Now the PE ratio is a snapshot of investor confidence. A lower PE ratio might suggest that investors think that their profits aren't growing very fast, while a higher PE ratio often means investors are expecting big things in the future. Now let's compare our British construction company, or the FTSE 100, to the S&P 500, which tracks the 500 largest companies in the US. Now its PE ratio is currently 24 times earnings. Investors are paying 24 times this year's earnings per share in the S&P 500. The difference right here in that valuation. That's very expensive relative to its own historic value of only 18 times earnings. But here's the big question. Why is the S&P 500 trading so much more expensive than the FTSE 100? Is it, or are there other factors at play? Well, that's what we'll explore in the next video when we look at something crucial, the earnings growth.
Man versus machine. Where is Aaron?
Where is Aaron?
Yes.
That's a good question.
We are here because Aaron, I'm here because Aaron is he on holiday?
He's on holiday.
Fantastic.
How dare he, right?
How dare he? My goodness me. But I'm very excited because I want to test this out. Let's Ange test this. Right. Take us through what we know so far about this portfolio. I know it's week on week. The man seems to be winning.
Yeah.
Versus machine.
Right. So that's so
Yeah.
we're now in war of the humans versus the robots, man versus machine. So very quick intro into what we're doing here. We have got two humans up against a multi-billion-dollar ChatGPT system in who can invest the best.
Yeah.
All right, so we're asking the age-old question is, can a human start to just actually have their portfolio making decisions to
An AI.
to the AI? Up on the screen, the first one is we asked ChatGPT to give us some market down of current market conditions for a UK investor. So we try and keep it really simple it gives us some bullet points.
Yeah.
The second prompt is then, all right, based on this, what do you recommend you change in the portfolio? So in week 1, we built the first portfolio. It came up with a foundational portfolio. Now, every subsequent week, what we do is we analysis, do you want to make it that portfolio, and we change it, but we in the initial phase, in the foundation phase, built our own portfolio as a response to see if we could enhance it. The only constraints, there's no leverage. We put maximum 50% into one ETF and 20% into a single stock behavior. We've got a benchmark, which is 80% MSCI World plus 20% to growth portfolio. And this is just, the usual disclaimers. This is for educational purposes only.
Not advice, trader friends. This is for educational purposes. Love this. So,
Yeah.
So give me the duration. Ange is always about duration. Give me the duration. Is it from this point to?
We're going week on week because that's how long-term investing is done.
Bring it.
You try and do long-term on a weekly basis. Yeah, this is just showbiz. We're just trying to fit it into the weekly schedule. So what I do have is I've got the 2 portfolios up on the screen, and this is the difference between the 2. So we've got the human allocation. Very different, but both offering balanced portfolio. ChatGPT, very well balanced. Subsequent to that, it made lots of. And what it's done is we've added in most recently, we've added in a FTSE mid-cap position, 2%, and we've also added to the UK dividend ETF, whilst at the same time selling off a bit of Lockheed Martin and selling off a bit of the short-term duration bonds. Human portfolio, no changes so far. So that's where the portfolios are.
So at first glance, there's a allocation compared to the AI allocation.
Absolutely. So AI allocation. For the humans, we wanted to try and capture broad-based themes. So, I mean, a big example there is that both AI and human AI picking 2 single stocks in BAE Systems and Lockheed Martin, whereas we just took a VanEck defense ETF, which is tilted a bit towards the US, probably not as much as I'd liked, because I wanted to defense position. And subsequent to the big beautiful bill, we had the EU tariffs, hundreds of $1 billion worth of American defense to shore up their defense system. So that's where the differences are.
I'm curious as well, because looking at the AI allocation, did the AI know that the Alaska
Chat.
So this was done before the Friday.
This was done before. So the changes that we made were what it wanted to do. No point did it mention the Alaska Summit. It's been one of the key drivers in that defense space. So what we'll do is we'll also have a look and see how this is how we are going to date with the performance human portfolio.
35 basis points.
Can I give the human portfolio some tips for the coming week?
Absolutely, I think let's do that. Let's just see what ChatGPT has to say about their portfolio.
Okay.
So I think we've now got this kind of poor performance over the last week. I want to know from ChatGPT how their performance was compared to the human portfolio.
Out of the holdings in the AI portfolio, 3 saw gains, and they're in the red. And with BA systems down a hefty 7%, Lockheed Martin dropping over 2%, that's a pretty significant. Even though the overall performance was only -0.33%, the components clearly show weakness. That kind of concentration in especially defense, really exposed some vulnerabilities.
Absolutely. I think I said it last week, ChatGPT's responses are getting better, and not only is it going to try and take over the portfolio management, but it's going to take over the show.
I have an issue with the voice because it should be an it voice. It shouldn't be a woman's voice. And the reason for this is because I stress tested the world's first humanoid that was given.
How did you stress test the world's first?
I was put in a pod in Davos to talk to Sylvia, who is the first ever robot. I can't say it's a person, robot, but it looks like a person. And in the pod, you're meant to ask it questions. Obviously, it to look like a woman.
Okay.
And obviously, Saudi gave this it woman nationality. I mean, of course, they're probably going to let it drive as well, right? Given Saudi Arabia's track record. But it could not get at that time in Davos. So each dignitary was allowed, a minute with Sylvie. You can find it. It had a female voice.
Okay.
It couldn't get my most simple favorite cracker joke.
Didn't get it.
Didn't get it. Didn't laugh. Could not get that at all. So that is why I say we stress test it. The joke was, what did the fish say when it hit a wall? What did the fish say when it hit a wall, trader friends? Damn.
There we go.
And it did not get it. It was like did not compute, right? So
Computer says no.
This is why we need better, but I think you're not robot to be able to
as a robot voice.
Yes, and also my thing is a robot can look at seasonality, but robot sudden Trump announcements, sudden tweets, Putin out of the ordinary.
Yeah, absolutely.
You still need a human.
I think that's one of the things is that
Hey, don't talk yourself out of a job.
Oh, well, one of the things with ChatGPT, what we've seen so far is that obviously all of these systems are built on training models, and if they haven't dealt with a scenario before, and I'm sure there must be some advanced AI that is naturally thinking, but if they aren't able to almost fit an example to it, they don't know how to react. And so, Trump coming in, they haven't dealt with a second-term Trump presidency before, and tariff man. Yeah, there you go.
Julian Wheeler, you heard it here first, trader friends from Shark Capital as well, in earlier saying that he does the algos have got it right, or humans either, because this summer correction everyone's been talking about, in his view, in his opinion, that happened in April, where we had that huge tariff tantrum. So seasonality for this year, in his view, is out the window.
Seasonality out the window, and why does he feel that?
Because he says that we don't normally get that sort of correction in April. So the steam has already been taken out of the market.
If you look at any of the analysis, there was always meant to be a weaker kind of first 3 quarters of the year, and then we were going to expect a strong finish to the year and a strong 2026 based on the election cycle. There was always meant to be Trump front-loading a in order to let them ramp up into the election so that they could try and secure a victory. I think the of the tariff shock was so large that the response had to be so urgent, and we've almost now seen all of that kind of front loading of increased returns and this risk on sentiment truncated into a small space of time. It is going to, I think what we're expecting is a lot more volatility now than probably what we were expecting in the beginning of this year.
Right, let's take Martin's screen, if we may, as well. Let's have a look at the performance drivers, human versus machine.
All right, so AI portfolio, it's been a bad week. Lots of exposure to Lockheed Martin and BAE Systems. BAE Systems coming down 7%. This is on the news of ceasefire talks, Trump now getting involved. And at the same time, you've got a larger weakness towards UK and European defense spending compared to the United States. And so that's why we're seeing Lockheed down as much. On the same breath, if you take a look at human portfolio, that was also our weakest position, was that thematic defense ETF. But defense ETF down just under 2%, whereas BAE Systems 7%, Lockheed Martin 2.5%. So we were able to mitigate some of those losses by having a diversified basket of defense spending. Gold as well, being one of the losers for both of our portfolios, down 1.83% over the last week. And again, this is on sort of subdued geopolitical risk. This is on the talks of ceasefire. But at the same time, there is a bit of support coming for gold now because we're seeing real yields coming down. So real yields coming down, that's supportive for gold. Doesn't mean that your storage price is so high. So that starts to make gold somewhat attractive. So maybe gold slightly buffered in the last week because of those real yields coming down. But then the big winners, NASDAQ, no real winners in the AI portfolio. They've got a bit of exposure there to MSCI World, getting some of that, that kind of rotation now into and the really supportive market we've had in technology stocks over the last week with earnings coming out.
Right. Shall I give the human portfolio a bit of...
This is your chance.
Ange edge.
Yeah.
Okay, here is the Ange edge for you. The gold is stuck as in the mud. Let's have a look at gold prices for you. And everyone I speak to in the defense space or has a position, basically this coming Friday, let's feel the mood summit, right? Let's feel the mood, but nothing essentially changes in that front. So what's going to happen is everyone's going to say, we're going to keep talking to the second time. Come out, has been achieved, but we talking. Taking a look at gold, what all that means is it's going to be stuck in a rut in that channel that it in since the beginning of around May. So wanted to replace that something else, then I would say look at the cyclicals, look at the Walmarts, look at the we already saw some of the cyclical change overnight. If you guys were trading the US close from the techs into the name Walmart and the potentially even the Home Depots, there could be a bit of a bounce in the coming week. Another one is everyone knows that I like energy and I'm big in AI, but have you looked at gaming? Any trader friends, you guys, gamers? Any gamers out there? Do you play computer games?
I don't play that many computer games. I was a child quite recently, and
5 years ago.
And I remember playing a lot of computer games then.
Oh, Espo. With Espo?
No.
So Espo, you see lots of there you go. And to the weekly trader friends, you can see a strong upward trend there. that has tracked higher. And the reason why I'm showing you this is part and parcel of that growing trend of people not just investing and trading online, but also if you have tasted and been in the US recently, you'll know that video gaming is now blurring with the fan jewels, with the betting.
Yes, that would ask you about is that I need to have a look at this ETF and see what it comprises of. If it contains like the big winners, which has been still referred to as online gaming, but it's actually just online casino games. And companies like Aristocrat have been really successful. The kind of profitability is almost obscene. So, yeah.
And don't forget, these they're not buying any raw materials. They're not selling anything, right? And so they're also tantrum that
exactly.
you could see out there. Also, your ETF, the China one.
Yep.
I understand your ploy, the reason why you've put. But you're going to have to keep waiting for that China dream to come because it's going to take a while. Lots of people have been waiting since August.
For 10 years for the China dream.
And everyone that has got a position or is thinking of a position, then they're watching the property market, the Chinese property market. You know, back in October, you heard me, in November, you heard me teasing China franc, so China franc Cabana, because you kept on going, come on, at some point, right? At some point. And then we had that day, huge continuous bazooka did not come, trader. One and done. And so that is why I'm saying if you wanted to swap out, to give the human side a bit of an edge, then maybe
we might listen to you there. But I think so. China, what I will say there is that the consumer's looking a little bit healthier. They're actually a bit subdued on their credit spending. So the overall debt levels have come down both in the corporate and in the sort of sector, we'll say. Property not looking too bad anymore. When it's the risk that I had sort of attributed to property seems to have really abated. So I think that the tariffs have been the major drawback, and also there hasn't been a cut in the Chinese central bank rates. So there was an expectation for a cut. And that hasn't come to fruition, and they seem quite hawkish at the moment. So that hasn't really put a bit of sort of fuel in that Chinese sort of. But we're going to keep it there for now, I think. What I do want to do is bring us on to the first part of our portfolio for next week. And the prompts that we ask GPT provide that comprehensive rundown of current market conditions for UK investors and delivered 3 key areas. One, looking at the UK equity market. The second being some sector highlights. And what I want to pull out from this is that it really thinks that UK market is the place higher. It's looking at healthcare, and it brings healthcare up a few times. So it's definitely picking up on a healthcare trend. Healthcare has been probably one of the markets in the last sort of 2 months. You can see the sector highlights. It is looking at healthcare and consumer strength. Investor enthusiasm in to do, and defense week. Defense has been probably the best performing sector, health performing sector, but it's looking at defense weakness and healthcare strength in last week, and it's going to make a decision based on that. Let's ask ChatGPT instead of reading through. ChatGPT, given the poor performance that you had last week, what are you going to do for next week in order to rebalance your portfolio? And
Based on last week's performance and the macro outlook for the week ahead, first, I'll trim some of the defense exposure, particularly BA Systems, which was down sharply last week. With markets reacting to the possibility of a Russia-Ukraine ceasefire, the short-term outlook for defense stocks looks shaky. Next, I'll increase exposure to more defensive income-generating assets, likely adding to the iShares UK dividend ETF or introducing more into the short-duration bonds. That should help stabilize the portfolio in case volatility picks up again. I'm also watching the UK labour data and PMI numbers, which could shift sentiment around Bank of England policy. If the data comes in weak, we might see more rate cut talk, which would support bond proxies, dividend stocks, bullet, and even gold. So I'll consider increasing gold slightly as a macro hedge. Finally, I'm holding on to my global equity core positions like MSCI World and EM for long-term balance, but keeping a close eye on US CPI and retail data later in the week. If inflation surprises to the upside, I'll need to reassess risk levels quickly. So in short, less defense, more defensive.
There we go. Straight from the robot's mouth.
What was the last bit? Less defense.
Less defensive.
I agree with the consumers. The consumer, I think that it's time for the slightly unloved consumer discretionary to come back into the limelight again.
Yeah. So one of the things that we did is when we feed the portfolio back to ChatGPT and we ask for the suggestions. So we've just had some common suggestions. When we feed it back and we then ask for the rebalance, this is what it came up with. So it has actually drastically changed the portfolio. So clean energy didn't have a great. So what it wants to do is completely remove clean energy and replace the entire position of clean energy with a new position in global infrastructure. And then healthcare, I mentioned that in the chat. It's definitely picking up that healthcare is now the sector. Now, I'm happy for it to actually take this investment. Healthcare has been really run down this year. I'm feeling like this is potentially too early. I like the healthcare space, but based on Trump's big, beautiful bill, which has really cut fiscal spending towards things like Medicaid, as well as his pressure on the sector to reduce drug prices, and he's got this new policy that he's brought in with regard to the lowest or the highest price overseas, ensuring that Americans don't pay more than any other market. Healthcare is potentially not yet at the bottom, but I'm happy for it to take that and we can try and see how healthcare performs. So I think that's an early pick into healthcare. And then cutting next era energy, 10% down to 8%, and actually reducing cash position in order to finance those other positions in healthcare and global infrastructure.
I like there's a suggestion as to how much to add or cut the position as well.
Yeah, absolutely. And the rationale, so use cash position to deploy the cash more productively. So cash has been, flat for a few weeks, really adding buffer to the portfolio. It's now taking position off, starting to wean off of its cash position. It's getting more exposure to volatility. This could pay off if we have a strong week. But at the same time, this is where that divergence is coming between our two portfolios.
I like the diversification into healthcare as well. That it has talked. That is part of my diversification play. So I'm going to put up my watch list there, and I've got Eli Lilly, I've got AstraZeneca, and GlaxoSmithKline as well. I will also be looking at Viking Therapeutics after speaking to Julian Wheeler earlier on from, because you're saying that Viking Therapeutics is a small pharma that has got this oral skinny pill that is looking very promising, but because of its size, it's also looking like a takeover target from the likes of AstraZeneca and GlaxoSmithKline.
Got you.
Right. Interesting stuff. I am so pleased that Aaron is away, so it gave me a chance to. I found this very useful. Let us know if you found this very useful, trader friends, and please hit the like and subscribe button so we can pit Ange against machine more often. Martin, always such a pleasure.
Yeah, thank you. And I hope Aaron is off researching more stocks for us to buy.
Well, on the beach.
I don't think he's on the beach. I think he's gone to Edinburgh Fringe.
Oh, yes, that's right, for a spot of comedy. And speaking of machine and AI and everything tech-orientated, there is one sector where gets some exposure, alternative diversification, some market watchers say. We have the fifth and final episode of my Decoding Crypto with Ryan Grace, head of Tasty Crypto, up next. And it's going to tell you all about why you should care, even if you're not in it, why you should care, how this space is developing, why crypto is in the headlines, and how it might be used in the future. Stay tuned for that next. Hey, trader friends, welcome back. Latest in Decoding Crypto, and in this series we're going to talk about the future of crypto with Tasty Crypto's Ryan Grace, all the way from Chicago. Hey Ryan, how's it going?
Hey Ange, I'm doing well. It's great to be back. Thanks for having me.
You know, lots has changed in this world of crypto. It's very fast moving as we know it. Let's just talk about, you know, the future of crypto first. Give us a brief overview.
Yeah, I think when you talk about the future of crypto, really what you're talking about is a convergence of two systems, the existing financial system and blockchain technology. A lot of efficiencies that can be gained from blockchain that you'll see start to be adopted. System at large. What we're seeing today is the tokenization of real-world assets, and that's assets such as currencies. The US dollar is one of the largest real-world assets that's been tokenized. You're seeing instruments, treasury bonds, debt instruments are being tokenized, and now you're starting to see a real movement. The uber rich, ultra wealthy in many. When you look at tokenizing some of these assets, or in a way kind of securitizing them through tokens, it makes them more accessible. People can participate in the appreciation. There's still a lot of constraints. It's not kind of as seamless, I think, with just trading tokens, but it does create an opportunity. I think that's still a ways away in terms of its importance, or seeing more so is the tokenization of financial assets. So things that sit in centralized databases and have a bit more friction in terms of the settlement process, that becomes a lot faster and it becomes a lot more accessible on a global basis. Tokenized equities are really not that important for US investors because investors have access to US companies via regulated brokerage accounts. But globally, it makes some of these companies and the ability to participate in these markets much more accessible when it's tokenized, when it's on a blockchain.
You talk about regulation. Are there concerns that you know, regulatory clarity and compliance might not be moving at the same speed? And how is this going to affect the adoption of tokenized assets across different jurisdictions?
Yeah, I think the regulation is always going to, in some cases, the technological innovation. That here in the US, regulators are just today kind of catching up with a lot of things that have existed globally. And when you look outside the US, in Europe, in Asia, you have arguably regulations that are a little bit farther along. You might not love those regulations, but there is, versus here in the US where I am, you know, that's still in development. I think it does act as a headwind in some cases in terms of participation by investors in various regions. A good example of that is the ability for investors outside of the US to access perpetual futures markets. Perpetual futures are a great, I think they're very innovative, and I think in some ways they're an evolution of your traditional standardized futures contract, but they're not available to US investors. So what you see is many of these companies that are looking to participate in this space and to adopt this technology, they're having to go outside first because regulatory framework in the largest financial market in the world.
Lots of people are asking after watching our interview, is AI's role in this? How is AI and blockchain converging? And I said I would ask.
Yeah, absolutely. I think there's a couple ways to approach this question as well. I mean, high level, if you believe that you're going to proliferate AI and you're going there are networks, economy, and economics themselves facilitate compute, 3D animation, or AI generated video or images is being leveraged different subnets that provide competitive marketplaces for today AI services. That could be LLMs, it could be training data, and the rest of the. I think that's going to continue to support the development of AI. When you look at distributed compute.
Or issues to do with, or do you think that we are at the point now, the tipping point now seen as infrastructure, right? And what kind of sectors will this impact?
Yeah, it's going to impact all sectors at the end. I think where you're seeing it first and foremost is in the financial sector and the financialization that we've kind of come to know and love, I suppose, adopting this technology because of the efficiencies, again, that are gained. But I think that it touches all industries at the end. When you think about the efficiency that you get from kind of decentralized databases, in some cases, it's not for all use cases. Think about, again, the growth of AI. And I think that it's absolutely sustainable and on one hand, and it's a little bit of a legacy argument in some ways when you think about Bitcoin mining and proof of work. It is obviously energy intensive, but at the same time, that's what makes Bitcoin store of value. It is proof of are only 21 million coins that'll ever be mined. And so you see that kind of digital gold side of it, right? There is that ultimately requirement that makes that special. On the other hand, when you think about scaling solutions for Ethereum, or you think about Ethereum itself or other smart contract chains, these all use proof of stake. And I think that you're going to see that technology evolve as well. So there's no real argument around energy use when you look at most chains and most of this technology outside Bitcoin. And even then, when you get outside of blockchain and you start to think about AI and all these data centers that are being built around the world, they're absolutely going to require more and more energy. But that energy is likely to come from small-scale nuclear reactors and the evolution of how we power the grid. Maybe it will be solar, maybe it will be, and there will certainly be some fossil fuels still that's involved in that over the next few decades. But I don't think that prevents this from growing or scaling, and I think you're watching it happen today.
Right, thank you very much for that. And for all you viewers, if you have any questions for Tasty Crypto's Ryan Grace, do send it to us on ask@ig.com and I'll get it personally sent to him. Ryan, as ever, so with us and hosting with me.
New all-time highs for the S&P. That's your Wednesday. It's overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Midtown Milan, here to join you for the rest of this hour. Futures market closes at 5 Eastern, 4 Central. If you're joining us on the platform, Tasty Trade on the website, tastylive.com. Come over to YouTube. Tell us what you're trading today. What do you think of this market action? A little midday dip for stocks was no problem because we closed the session here on the highs. The S&P 500, 64.91, a new all-time closing high here for the stock market on this Wednesday, breaking through the highs that we saw at the end of July. Likewise, the NASDAQ, which spent a good chunk of the day in the red, finishes higher, up by 0.03%. It's a new all-time high. And the Russell's rip post-CPI, that continues up to a fresh yearly high here. There's lots of risk taking in today's market. Silver's bouncing 1.5%. Bitcoin's up over 2%. Ethereum up 4%, approaching $5,000. Wow. Risk is on. Dylan, our star of the supernova. How you feeling today?
A little, the problem is I think I didn't sleep well or something because I spent a bunch of time thinking today.
Oh, God.
Yeah, it was a disaster. So, so I didn't do anything, but at least I have the things that I had on, and it's ultimately more good than bad. But it just seems wacky, the whole thing. But anyway, I think it's the lack of sleep. So my conviction level is actually diminished, but I wouldn't overinterpret that as anything other than sort of the risks of thought.
See, this morning I did the opposite. I woke up, I got an IV, vitamin B, taurine, magnesium, Toradol,
You gotta get
Zofran.
potassium in there too. If you're gonna
Don't worry.
creatine.
I got that shot that makes it taste like Flintstones in your mouth. I'm ready to run through a wall. What rib pain? There's no more of that. And that was, and I said, I'm feeling pretty good today after I came home. Time to buy more stocks, Mr. Radigan.
Look at you.
So I'm back in. I'm looking out now on the longer term basis, 48 days. Little thing, just dipping our toes in. Pinocchio wants to wet his beak here a little bit. It's a Godfather reference. Long the 6,700, short 6,750. It was fun, Ilya. No, it wasn't. Being a bear
No, it wasn't.
for the past 2 weeks, or even directionally neutral. But the breakout in stocks is at least there. We were talking about this yesterday on the show. If we see the further progress, it looks like there could be rotation afoot. Maybe that gives the S&P 500, the Russell, more room to run. And sure enough, they are leading our NASDAQ here today.
Yeah.
So, Ilya, I think you have declared this poking of the bear finished.
Yeah, you have to trade with the price action. This is where you have to remember that all of your thinking, if you so choose to engage, does not mean anything if the price action isn't complying. And so, in so much as we had a break of the high on the S&P today, you had a break of the high on the NASDAQ today, or yesterday, you had a break of it on the Russell today. I'm not fighting that. No, thank you. And this is why I poke the bear with cheap vol risk-defined verticals. I mean, across all three indexes, I ended up giving away less than 1% of equity on each attempt. This is why I do it that way. This is why I build tons of duration into these things to dilute exposure to delta. This is why I use ETFs and not the futures, to keep things small, to keep risks contained, because there's always time to scale up if the price action goes your way. Price action didn't go that way here, clearly, so I'm out. Okay, we'll try again when it seems like there's an opportunity. But the risk reward has been reset here. I don't think it looks awesome in either NASDAQ or the S&P, but it looks solid in Russell.
Dylan, this stock enthusiasm was across the board here today. I even saw a company by the name of Bullish have its IPO.
Actually, I visited the New York Stock Exchange today from Milan, interestingly enough, and noticed the banner on the building. Using my teleporter, of course.
Naturally. The company IPO'd on Wednesday in a range of $32 to $33, which valued the company at $5.4 billion when it opened, putting it right now, given current prices, it has a $13.2 billion debut, now at $70.91. Not too shabby, Mr. Radigan, but it's a crypto company that's surging here out of the gates on a day when we have crypto pummeling the market, moving up to new highs. I see this as a new high close in the BTC futures contract. I see this as a new high close in the Ethereum contract right now.
Mm-hmm.
Is this a macro story, Dylan? Are you looking at the money leaking into the world of crypto? And is this something bigger in the state of play that maybe we're not paying attention to?
Boy, I mean, I guess I'll focus on what I feel like I know and sort of avoid what I don't know. The biggest thing that we know, and I think you hit on this the other day, and I think we sort of probably haven't hit on it enough recently. We hit on it a good bit a few weeks ago. The Trump tax legislation is so beneficial to the rich, and it so encourages the flow of money into assets, because people who already have a lot of money, when they get more money, don't necessarily buy more things. They just park the money in financial assets or real estate or art or whatever it is. And so I do kind of wonder to the degree to which that is a factor in all of this. You know, even in the sort of the ebullience of the supernova, is it entirely driven by AI? Probably not, right? It's probably driven by macro factors about the flow of just the availability of cash money. And so I think that that's a meaningful consideration. I do, you know, Ethereum. Why would Ethereum suddenly break out? Who the hell knows, man? You know, why didn't Ethereum do anything for the last couple of years? I mean, you could make a case that, well, now because you have the crypto president, that it's all crypto positive. But why now? I don't know. You know, is it an indication of negative dollar sentiment? I don't know if it is even. You know, I do think that when it comes to the idea of not thinking and instead, you know, buying assets, that buying an asset that is crypto should be on the buy sheet. It shouldn't just be, you know, Meta, Nvidia, and Microsoft. Even though when I think about crypto, I have to really ask questions.
I mean, I think when you look at sort of money chasing assets here, you get to a conversation, especially on a day like today, where you have a further winding up of Fed rate cut expectations. The markets are now starting to lean in. Maybe the Fed will do more than 2 cuts this year. I mean, the bonds rally today pretty significantly, and you get this sense that the market has just fully embraced this kind of a risk-on perspective, saying, oh, well, the money's going to be cheap, allocate accordingly. And so you see it across the board today. If we look at what the markets are baking in now for Fed stimulus, it's 125 basis points between this year and next, and this year has gone out to 58 basis points. That's the most dovish it's been all month this month. And if you look at next year, you're at 68 basis points, which is way more than what the Fed has. And the cumulative 125, I mean, we're talking 5 rate cuts to the Fed's 3, and that's the most dovish we've been since basically NFP. So we're in a place here, seemingly, where money is perceived like it's going to be cheap, and the economy hasn't, in some sort of an unequivocally obvious way, fallen apart. So money is just pouring into risk. The dollar's a little bit lower today. You're kind of seeing it across the board. And it looks like Chris is having some.
We lose Chris?
I think so. I think so. I can still see his charts, though.
What I'll get at, because all of this, even though I know I've been the champion of not thinking, man, it seems like if there was ever a time to consider a little short nibbling, just on the price momentum. I mean, I guess I'm I'm totally contradicting myself, and I'm sure it's because I didn't get a good enough sleep. But I just feel like the sort of uncorking today on that we're going to get all the things that you just talked about, Ilya. Like, if I wanted a short nibble, where would you put me? I guess it'd be my question.
This is, I think, one of those times, and this is why I sort of cleaned house today. This is one of those times where, for me, I need to see a price action signal. When I saw the price action signal at the end of July, showing the market is shrugging off good news, it's embracing bad news, it's starting to roll over, you go, okay, the price action is whispering things here. Let's take a shot. Let's see. Vol is cheap. Yes, yes, no, no. And I just don't see the price signal here. So I think rather than saying, okay, I'm going to bet that equities are wrong, you might instead look and say, well, I'm going to bet that the bond market is right. And say, okay, well, either the equity market is right or it's wrong, and it can, as we know, remain irrational longer than we can stay solvent. So you have to be careful.
Thus, my whole thinking issue. But yes,
right.
So then, how do you square today's bond market action then? Because I will tell you, today was a difficult day for me in my mental model of how I'm viewing the market. Right. I think yesterday was a big regime shift with the way small caps performed. We're going back into reflation. Fine.
Maybe.
How are bonds are going back up though today? Gold's not benefiting.
I think that's what it is. I mean, look at the Fed funds futures pricing, look at the bonds. I think what we're seeing today is optimism about the cheap money is coming to save us all. And whether that's
meaning that the CPI was a green light for rate
meaning the CPI was a green light.
Well,
meaning the CPI was a green light.
CPI being a green light or not, we've now had how many months where we've been running above the Fed's target, Elia? 67?
Oh, I'm not suggesting that the markets are right to think that we have a green light.
But if the green light being, let's say we're getting the Fed cuts, what does that mean for asset prices? Yeah, they're going to let inflation go up more. But Dylan, it effectively, the market is now repricing a Fed's inflation target from 2% to basically 3%. Like if the Fed is going to be conducting looser monetary policy in a world where, if you look to the Atlanta Fed's inflation dashboard, every single metric is flashing red.
Mm-hmm.
But the economy's not slowing down. So if you're projecting cash flows and equity valuations expecting 2 to 2.5% inflation in perpetuity, what does your growth rate look like if you're going at a 3% run rate?
Mm-hmm.
So yeah, we're going to get looser policy, but this is going to, Dylan, this is certainly not a thinking question. If the Fed's inflation target is 3%, is that A, materially different than a 2% target for businesses? And if it's not, are equity markets undervalued? It's a stupid question. It's a stupid question.
The market has been saying
I think it's the right question. Go ahead, Ilya. Sorry.
The market has been saying for months, right, that inflation is not an issue, and it's not because they don't see the tariffs being inflationary, because that would be silly. What we are instead seeing is the market saying the tariffs are going to be such a hit to growth that part of it will be more disinflationary on growth grounds than the upside shock is. And the Fed, because it takes a single rate cut anywhere from 12 to 18 months typically to work its way into the economy, the Fed needs to get in front of this thing. Because if we look at the break-even rates in markets, they've not really recovered since April. They've been in a choppy range. But whereas stocks have rallied, inflation expectations, market-based, haven't really gone anywhere. They've stopped falling, but they're, for the most part, anchored in a kind of sideways band.
Mm-hmm.
And so the market is telling the Fed, yeah, inflation measures might be high now, but you don't need to worry about anchoring inflation expectations. This is not going to spit out on you. You can start to pave the runway because we're going to need it, because otherwise you're going to miss the window.
Mm-hmm.
And the markets, for their part, are now convinced there is a 0% probability in Fed funds futures that there is no cut in September now. 0. It's 94% almost of a single cut and a slight sprinkling, a soupçon, if you will, of a probability that you get 50 basis points in September. The markets are sort of fully running head first into, we are going to get easing, and it's going to be wonderful and glorious, and it will paper over all of our sins.
Thus, the no-thinking supernova thesis gets stronger, not weaker, in the face of the CPI green light, which oddly then caused me to think.
Yeah, so, and the thing is, you would be forgiven for thinking, because when you look at what the CPI number was, you saw tariff-based inflation in it. It's leaching slowly because obviously the first quarter, everybody ramped up inventories, and so you haven't seen the full inflation increase in prices yet.
Mm-hmm.
You're seeing in the PPI data, and we'll see more when they're updated tomorrow, but for 3 months now, you've seen that intermediate level inflation is getting bogged down because businesses are taking it into margins and not passing it on, even to more final wholesalers, never mind to consumers.
Mm-hmm.
It's just slowly starting to leach. So, of course, the inflation numbers are going to get higher because they can only take it on the chin for so long. I think from the market's perspective, what they're saying is, yeah, but when all of this hits, it is going to be such a growth nightmare that you should be getting ahead of it now.
Mm-hmm.
I think the real question, I mean, obviously we have Jackson Hole coming up next week. If we get a Powell speech where he's like, yeah, maybe we're going to have to be slow, Maybe we don't see an urgency. The markets are all kinds of up in arms, but we don't know really what that's all about. If Powell doesn't reinforce all of this, if he doesn't stamp it, that's going to become an issue going into September. If all of a sudden the markets find that all of this dovishness is wrong,
catastrophic. I mean, this thing, that's why I'm saying I got sort of sucked into some thinking, which was, you know, especially with the upswing and the green light, like it just feels really, really perfectly, you know, the cliche of price for perfection seems very sort of apropos. I don't know. I don't know if it's a soupçon, but I do believe it is apropos.
Well, and quite right. And the moment that this market shows a sign of weakness, like if the S&P, let's say, dips back below its July, like late July going into August high, if this breakout fails, I'm right back short.
Mm-hmm.
That would be a tremendous signal here. I mean, stock markets love to squeeze sellers out. So perhaps this was the last kind of smack on the chin, and then it turns once everybody has experienced maximum disappointment from all sides. But the price action will say that. It will show us.
I mean, do you understand my thought, Chris? We've lost him once again.
Yeah, it
just feels too good. I mean, I'm all in favor of the goodness, but this is ridiculously good.
Yeah, I mean, you get to a point, and I'm going to talk about this on Macro Money today, but you get to a point where you have to start asking questions about economic growth and whether gravity exists. And there seems to be this kind of cognitive dissonance between the markets going, oh, goody, rate cuts, and stopping short of saying, why do we want this so bad?
Mm-hmm.
Why do we need all this easing?
Mm-hmm.
Why is the Fed saying, hey, listen, the economy is fine, and the market goes, no, it's not fine. You better give us 3 cuts next year. And the Fed goes, how about 1? And the market goes, 3. But why? Why is it that they want them so bad? Is it because everything is great? Then why do we need the cuts? So it feels like it feels like we're watching Wile E. Coyote run before there's the realization that ground has ended.
And I just worry whether I'm thinking.
Right. And this is why I won't go long here, but I'm also not willing to stand in front of this level of momentum and go, oh yeah, I'll be right eventually. No, I have money at risk. I'm not just going to lose money for no reason.
Mm-hmm.
I'll back up. It's fine.
The interesting thing
will present itself.
But I've had a good month not thinking.
I mean,
truth.
Not thinking is not a bad thing. I think the key is not, I think, it's not to think or not think. It's to let the price action think.
Mm-hmm.
Like we can have 5, 6 versions.
But I just feel like
a
this
possible
is a
world in our head.
Again, not to go all thought based, but I just feel like this is a classic sell the news. Like you have all the supernova jibber jabber from me and everybody else.
Sure.
Now you have the inflation green light. You're basically now considered a guaranteed rate cut next month. The market spikes. Like if like this is for me in a thinking man's world, this is a classic sell the news.
Yes. And as ever, right? And this is sort of the cross that all of us that like to think about macro things have to bear. Macro tells you absolutely nothing about timing.
Mm-hmm.
Like you can, and I do this exercise where you picture the world in multiple versions, and you go, okay, well, if the mix of assets is, dollar is doing this, and while stocks are doing that, and gold is doing that, and yields are doing that, and oil is doing this. Okay, that's a world like this. And then there's a world like that, and a world like that, and a world like that. And you can like one of those more than others. You can certainly think yourself into one of them. But I think you have to be very, very focused on risk management and on what the price action says, because as ever, if you're right at the wrong time, you're wrong, and you're going to lose money. And at the end of the day, I would much rather make money than be right. So I'm going to back up, but not lose my conviction.
How does the dollar shake out in a world where rate cuts are happening, but the dollar's already on its ass?
I think that's one of the most interesting things on the board here, is that the dollar is quietly attempting to bottom.
That's what that's what I was kind of what I was getting at, where it's like, okay, the dollar actually looks kind of okay in the context of a narrative that could say that the dollar might not be that okay, but it seems like it's behaving okay in the face of not okayness.
Yes, it could have been much weaker this week for everything that's coming together, and all the hope and yearning for these rate cuts. The dollar might have taken a much bigger beating than it actually took.
Exactly.
It's down a little, but it still looks like,
especially when you got the bond move like it is in the CPI green light, I could make a weaker dollar argument quickly and robustly.
Yes. And I think if your argument was we're going to have a stronger dollar because rates aren't going to go down, I think that argument increasingly flimsy. Because obviously we're going to get these rate cuts. I think the larger issue is now that we're on the other side of the April scare, and we've sort of gotten past the point where, and I think stock markets speak to this, where we thought for a while there that we were going to recklessly crash the entire dollar-based financial order. And then the bond market got quote unquote yippy. And the administration understood that, like, listen, there's policy we can debate, and then there is self-harm. Stop the self-harm. And they did. And they did. And I think when that occurred, and whoever is in there explained that, listen, you can do all kinds of things, but if you don't have this dollar recycling into our markets to keep interest rates in check and keep the government financed, then all of your great ideas are worthless, as is everybody's idea. Right, left, whatever. It doesn't matter. You can't run this thing if you break the dollar, because then you destroy the U.S.'s ability to finance debts cheaply. You essentially opt to say, we could have borrowed with impunity for very little money, and we're going to purposefully not. I think they learned that that's a stupid thing. And so now that we've learned that, the dollar can reclaim its haven role. So if there is some sort of a shakeout, I think we go back to dollar liquidity, much like we did in 2008 when everybody was all, wait a minute, the crisis is in the US. Why is the dollar rallying? Because it's not rallying for any kind of growthy reasons. It's rallying because money has to go to cash, and it's the most liquid version of cash. That kind of argument starts to make increasing sense to me.
I know we started brushing up in here into the tariffs for a quick second, Ilya. I saw this, we talk about the dollar's role in the world. I'm thinking about what happened at the start of this week with the VIG that's given.
The VIG.
This was a Washington Post report. Trump's using the tariffs to benefit corporate allies. I mean, allies, not corporate allies, isn't the lens after this news over the weekend that Trump is doing things that are good for American corporations, foreign market access. I know it's a silly theory with SMH doing what it's doing and then ultimately NVIDIA and AMD being the beneficiaries, I would suppose. They're not even strong in today's market. There's a rotation that's very healthy that occurs. But the administration clearly cares about the equity market. And if we're going to be running deficits, I think about the Mundell-Fleming model. What happens to asset prices? What happens to asset prices with loose monetary policy and loose fiscal policy? Asset prices inflate. So I don't think we ever need to do any more thinking here about this, Dylan. And I'm so surprised. I'm shocked and disappointed in myself.
And the interesting thing is I've started thinking for the first time in weeks, and I'm now nervous because I think we're on a sell that I think it's too good now. I think the CPI situation is alarming. The CPI situation is alarming. There's plenty of things not to like in the CPI report. I don't mean I mean the CPI green light, the price action. I feel like there's a complete release from any perceived risk. CTAs are levered long. I mean, this is why I don't think the CPI report's fantastic. And I think the context window is when we look at this dashboard, we had this dashboard last year. We had this dashboard last year flashing red, and the Fed gave us 50 basis points of cuts. And the context there was we just had the SOM rule triggered, right? What is the SOM rule? Claudia Sahm, former Federal Reserve official, has this rule, as it's known, where if the unemployment rate, if the 6-month average of the unemployment rate rises, if the 3-month average of the unemployment rate rises above its lowest level over the past 12 months by more than 0.5%, then you're in a recession. So this rule comes out in 2021. You backtest it through history. It has a perfect track record. So when it flashes last summer, the market goes, oh, it doesn't matter that inflation's too high. The labor market's cracking. The Fed's got a cut and they're behind the curve. But the Fed wasn't behind the curve. And the labor market stayed strong. And so their cuts gave us reflation. Asset prices go up. Gold, Bitcoin, stocks, bond yields are higher. I would point out that if you had the same labor force participation rate right now that you did at the start of this year, the unemployment rate would be closer to 4.9%. And that decline in the labor force participation rate probably has to do with Trump's deportation policy. Probably. So thinking about the context then, these numbers are mostly lower than what you see in the left side column here from last year. A 4.9% unemployment rate, jobs growth that's probably at a break-even rate near 70K, 90K now, speaks to a Fed that is probably going to cut and probably gives us reflation again. I mean, it really does feel like we are running back last year's Fed policy decision-making at all the same exact way. This time we didn't have a big crash at the start of August. Am I wrong for thinking that as an anchoring point, Ilya?
No, I don't think so. I mean, I think you look at sort of to both Dylan's point and yours. You look at this thing and you go, that CPI report that everybody has so embraced over the past 24 hours was at least mixed. Like, okay, fine. It wasn't outright awful, although you can very easily look and see from June to July how you have the erosion of the defenses keeping inflation out of CPI start to show up. You have the biggest contribution from the goods side to inflation in over 2 years. Core goods inflation accelerating. Highest since June 2023. Over 2 years again. You're watching it. You saw in the second quarter GDP report that after in the first you had a run-up in imports and a run-up in inventories. Now inventories are coming down so much that investment is actually a detriment to growth on net. So there is no investment outside of winding down these inventories. And imports have stopped, basically. So those inventories are not getting refilled. So the insulation you had from that, from having essentially just stockpiled cheaper goods ahead of the tariffs, you're not continuing that stockpiling, even through the 90-day pause. And you're going to get PPI data tomorrow that probably tells us that businesses at the front end of the supply chain are still eating it in margin. So the defenses are weakening. And it's very like we're about to get a bunch of GDP data from other economies not called the US this week, and it's weakness expected across the board. So the US is still the only game in town. We're going to get UK, we're going to get the Eurozone, we're going to get Japan. So as you look at the landscape, it's very easy to say, well, this is why the markets want these cuts. The cognitive dissonance is when they get a little sliver of something that tells them the cuts are in, they go, oh, great, risk on. But they forget the part why they want it in the first order. And that's frothy behavior. But
there's certainly froth in the market.
But from a practical perspective, like that they jumped on the CPI and went, oh, yes, everything is healed. It's like downing Vicodin for a broken arm. Like, your arm is broken. You just don't, you're just choosing not to feel it right now.
Well, there is forget the business side of this. I mean, there's meaningful evidence that the consumer is slowing down.
Very
Dylan,
meaningful, yes.
I used ChatGPT to put this together after I saw the Kava earnings. And I recall the Chipotle earnings were bad and the Sweet Green earnings were bad. And instead of just doing them by the numbers, I had ChatGPT go back in time a year. So the same store sales year-over-year growth for Kava, the Mediterranean fast casual company, 21.2, 10.8, now 2.1% growth. Chipotle, 5.4%, negative 0.4, now negative 4% year-over-year same store sales. And then for Sweet Green, fourth quarter, it was plus 4%, first quarter, minus 3.1, second quarter, now minus 7.6. Whether or not that's, Sweet Green, I use the same store sales because their margins on labor have improved. The stores in which they have implemented their infinite kitchen, basically the automated salads, we have one near us. It's like 1 or 2 employees working on those stores now. The labor savings boost the margins on a per store basis from about 23% to about 30%. But even that's not enough for the companies to see a significant decline in traffic. Is this one of those canaries in the coal mine that, in the back of your head at least, if American consumers are no longer going to fast casual, they're being priced out or they're trying to save some money, gives Ilya's point of view a little bit more credence?
I mean, I'm in a weird situation because I've been the most ridiculously bullish person on this panel for the last few weeks, and I'm flipping over today. I'm on lookout below.
So let me get this straight. I finally get on board after you chatting me for weeks, and
Totally.
I get onto the ride, and you're sliding out. You're like, okay, have fun on that roller coaster.
It's terrible. I feel bad.
Yeah,
I feel like it's like
enjoy yourself.
I feel like it's some sort of cruel manipulation on my part, but for the fact that I believe you're an independent, sovereign individual who is beyond my influence. But I do believe that the AI supernova is one thing, but when you lay in this sort of absurdity of this interpretation of the CPI green light, and honestly, even slap on the Ethereum rally, which I take as evidence of another exuberant red flag, that Ethereum finally goes, that the rate cuts are a go, like that the next thing that happens is things get weaker.
It does feel very rug pullish.
Yeah.
If that's a word.
Like, I just feel like, okay, What else? What other good thing can I possibly give you?
Yeah, just the companies that make up the restaurant ETFs just don't look good. They don't look healthy. The only one that's working out here well is DoorDash. Aside from that, this is about the automated future. If the economy's falling apart, where are you going to go work? It's a depressing set of circumstances on that end, but heck, stocks are at highs. So what's there to complain about?
But
Market can stay irrational, long as we can stay solvent.
Well, this is your K-shaped thesis, right?
It would be.
And it's sort of, I mean, I guess you can make an argument that, to be long the super, that basically, I don't know.
Be long companies that cater to services for the wealthy. Yeah. I mean, so I got an interesting comment yesterday. It's like, oh, Chris, you're not sounding like your usual self. What's going on? No, I mean, I'm not trying to rationalize what the Trump administration is doing. I think all of this is incredibly stupid. What I'm trying to do is figure out ways to make money within that system of what I think is incongruent and illogical decision making, which, again, viewing it through the lens of the market is a playground for the typically wealthier. 90% of the stock market is owned by 10% of the country. 56% of Americans own equities for what it's worth, but this is mainly for those that are well off. Who's getting the benefit from all these new laws? Who benefits the most when interest rates goes down? People can refinance their companies, right? Refinance their debt. It's the wealthy that have the ability to relever themselves over and over again. And just identifying that to be the system here. How do we operate within there? I mean, Uber, DoorDash, you're using those if you have a little bit of disposable income. And that's something that Raphael Bostic pointed out today. Raphael Bostic, the Atlanta Fed president, in his speech, noted very specifically, as was pointed out to me on Twitter, not only is inflation running above target, but upper income consumers are holding up. And upper income consumers are about to get a big tax cut over the next few months. When the calendar changes, salt's back in play. Dylan? It's good for people in California, New York, Illinois.
This is a beautiful time to be rich in America.
Gilded Age 2.0, baby.
But interestingly, Porsche says their business model doesn't work because they got themselves wrapped around a tree on electric Porsches that nobody wants. So just because you're a luxury brand, or LVMH is in the tank, by the way. So it's not so linear as to say, oh, well, the companies that cater to the rich are obviously the best way to do this when LVMH is on its ass.
But those are goods.
Fair.
We're looking for service companies that cater to the wealthy. So like a private jet operator, right? That's going to be fine. But I do hear what you're saying. Like LVMUY is the LVMH Moet Hennessy ADR here in the United States. Yeah, it's been hammered this year. Absolutely hammered this year. But it's a goods, right? We're putting in these barriers for people to import things from abroad. Is that going to affect the marginal wealthy person? No, because they'll just fly there on their vacation and they'll pick it up in person. But I think that if we're going to be this is the system that we're in. We went through regime change yesterday. The Russell did not care that yields were up yesterday. It didn't care that yields were down today. The home builders, these things are ripping the past two sessions through the roof. Rate sensitive stuff. Who's going to be able to buy new homes, Dylan, at a 7% mortgage rate? It's going to be your median
cash money, baby.
Only people who are very wealthy.
Cash buyers.
So we're giving all these the wealthy top 20% of income earners in America a big tax cut, and they're going to put it into real estate and
Ethereum, apparently.
And you can't put it into New York City because if you're a real estate investor, you're going to be stuck in a rent-controlled or rent-stabilized apartment, as people in Wall Street would tell me. So you're not going to invest in existing holdings. Forget our XLRE call, Dylan. It's all about building new McMansions. How cynical do I sound?
Very.
But that doesn't make you wrong.
Well, the one thing that you missed, Chris, that we kind of went partially into it, but I think it's worth revisiting while you were experiencing your wireless fidelity connection issues, was the relative apparent strength of the U.S. dollar in a world that could argue for its relative weakness.
Yeah.
That maybe the dollar is ready for that the bottom is in the U.S. dollar, I guess is what we're getting at. Although I'm happy to talk about oil too, if you want to flip oil charts at me. I always love a good oil conversation. It's one of my favorites.
The dollar's bothering me here, Elliot.
What's that?
The dollar just bothers me so much here right now.
Bothers you?
It's not, how should I say this?
Like a sore knee?
Like it should be doing a little bit better. Yesterday, yields were up, the dollar was down. Today, yields are down, the dollar is down. That's not that narrative elasticity, narrative flexibility.
I think it kind of is, actually, because I think it's telling us that well, sort of, kind of. It's telling us the dollar doesn't care about yields. But the dollar not caring about yields is actually good for the dollar because yields are going down. That the dollar isn't cratering here. That we don't have the kind of a breakout in the euro, in the pound, especially the yen. That you don't have a breakout in the yen in an environment where the whole hopium story in stocks is a oh goody rate cuts story in the wake of CPI, that the dollar isn't getting absolutely bulldozed over here and still has the bottoms in July and isn't even trying to test them. That's interesting.
That's what I was getting at.
That's interesting. And it's tempting to say that the reason why it's holding up as well as it is because we haven't really seen the shuffle in policy expectations change very much on net. So let's take the April low for the policy outlook this year and next. At that point, that was like Liberation Day, maximum holy moly. We were looking at 137 basis points in rate cuts this year and next. And most of it was for this year because the market was all frothed up thinking the world is over. Since then, we've come back to about 50 basis points for this year and more for next year. But the sum total is 125 basis points. So we've gone here and there, but we're not building more easing in the kind of way that the dollar would hate. And tellingly enough, the dollar bottoms basically July 1st and has not retested those lows. Even as we get more easing in relative terms on the board. So easing wise, we've gone from as little as 80 basis points this year and next in mid-May. Since then, we've gone nowhere but more dovish. We're at 125 basis points now. Even if you take the move from mid-July, where we had 100 basis points, now we've added an extra cut. In that adding of an extra cut, the dollar has not sold off. It's actually found something of a floor. That tells me it's probably done because it really should be falling if rates were the guiding light.
That rally at the end of July just has not seen much of a bounce yet. But if there's a place for the dollar to find a low right around 97, 98 and a half, right, this area down here.
Defend it right here.
This is kind of where we've seen the previous bounces in April and again in June try to take place, maybe a little bit lower into 97, but there's a band down here. I will point out that the two places that I've been operating in the yen and the Canadian dollar, they haven't really turned the corner yet. So I haven't been feeling this pain of the dollar fall off.
Me neither.
Dollar CAD, for example, I'm still short the call spreads up against this effectively 1 month moving average. We're in at the GC CZ5. 73.5, 74. There's 51 DTE. It was put on when the IVRs were in the 50s. So as long as we just hang out and or drift lower, we're cool. So I mean, that's kind of where, if I'm thinking about a dollar rebound, where would I want to play it right now? I'd want to play it on the currencies that aren't succeeding, versus the greenback at the current moment during the dollar's brief period of pullback. So the yen,
Canadian dollar, Swiss franc.
Right. We had our election pull off, right? We dropped. Okay. The election results come in. We've now neutralized. Everything's fine. So we're sitting here still. I still like more yen weakness. It's an 11.6 IVR. The volatility though across the currency space, I think this is worth noting. Typically, the euro really is the only one that has significant enough trading volume if you're going to operate in the currency futures option space. Maybe the yen. You see 122,000 contracts traded here in 6E, 102 in the yen. You go elsewhere, though, and it's a lot smaller. Even the pound, 49.2, Canadian dollar, 42.6. Some of these things would be better served to be looked at on the Tasty FX tab if you're on the platform. On Tasty Trade, of course, you can trade both there on the platform. Now, Spot FX, Ilya, which is where you and I cut our teeth originally in the world of finance. But all of them are here with all of the crosses. Dylan, you want to hedge your trip to buy those Turkish delights? There's euro, Turkish lira on the platform as well.
Thank God. I was going to abandon the whole system if they didn't do that.
Okay, so we do need to talk quickly about gold and silver before we go out the door. Silver has a big day today. Gold, not necessarily. Ilya, what was a little bit of an evening star candlestick cluster at the start of the week? Highlight that here. Now looks like a more of a morning stick candlestick cluster. Here, buttressed by that 1 month moving average. This looks like it wants to go. Gold, obviously, less the safe haven of the two, or more the safe haven of the two, less the speculative asset of the two. It's pinned at 3,400. For the life of me, I'm trying to get off an iron condor here today, 76 DTE. We're getting a 2.5 to 1. Actually, I'll just put this back on the platform right now. At 76 DTE, looking at the working order, which doesn't get filled now, it will be filled later. And we will get in. This particular trade is going to be a 62% pop, risking 2.5 to make 1. And the one that you're making is more than the buying power used. I really want this to be filled. But if we're going to think about gold, I have missed this trade a number of times. Arrogance, imprudence, not updating my worldview quick enough as things progress past April, May. 3,400 has been the Bob Barker price. The price is right here for gold at the current time. And I know it's only a 16.6 IVR, but a 2.5 to 1, 3 to 1 risk to reward in a 60 to 70% pop. You got to take that almost every time if you're going to stay mechanical.
For me, I'm sitting short vol here. I have it through calls. I've had it through puts. Depending on sort of where we are in this range, the current iteration of the position is in calls, short calls, vertical, because it was done near the top of the range. And I'm perfectly happy to just sit on this for now. It's still net up. And the premium received far outweighs anywhere the P&L has gone this way or that. So I'm just going to wait here. I'm going to wait for this thing to pick a direction. I'm staying away from silver because that has all the jumpiness of what's going on now in stocks, and I don't need any part of it. I've just taken myself out of the firing line for stock market shenanigans today. I don't need to get myself back involved, especially through a higher volatility, jumpier, less liquid version of risk on. But in gold, I am perfectly happy to just sit at this point and just let the thing work for me.
All right, Dylan, take us out. You wanted to sling some oil here. What's the plan with oil? It fell back today. I'm feeling a little less optimistic about this staying neutral. If the world's so good, shouldn't oil be up?
If the rate cuts are happening, and if tariffs are happening, the non-thinking man's interpretation of that information is that it's indication of reducing economic momentum, and as such, reducing demand for fossil fuels and transportation fuel. Not to mention, tariffs specifically target a reduction in global movement of goods and services, which is the most energy intensive. So the only question with oil, I would say, is whether the decline we're looking at right now already reflects everything I've just said, or whether there's another leg down in oil as economic activity generally slows down, and specifically as multinational import-export activity slows down, which, we'll see if that even actually happens, considering how price elastic and how tolerant everybody seems to be of a higher price. But you can, the non-thinking man could make a case for at least, I guess the 22, the IV rank doesn't get you too excited, but a call spread, or some short. If I was going to do anything with oil, I'd be short. Let me put it that way.
Well, it looks like it may be breaking down, but we'll have to cover this tomorrow because overtime is out of time. For my fellow non-thinking men, Dylan Radigan and Ilya Spivak, I've been Chris Vecchio. Good luck trading. We'll catch you tomorrow, same time, same place, 4 Eastern, 3 Central, right after last call. We're coming back, though, in a little bit. Brief break. Tasty Live continues. Ilya Spivak with Macro Money. See you there.
See you there, everybody. We get another push higher in the stock market as we embrace that rate cuts are apparently coming, and coming for sure, in the wake of that CPI report. We talked yesterday about how that report was at best mixed, but price action would not be derailed. And so we have another push higher from the stocks across the major indices today. But the question remains, why are the markets so happy with these rate cuts coming? And why do they want them in the first place? Is there some sort of cognitive dissonance between wanting support for the economy and forgetting why that support is needed? That's what we're going to tackle here on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And we'll take a look at the price action today and take a look at how the markets got themselves here and what it is that they're celebrating, and then consider whether the logic makes sense and whether then from there is a trade to be had to express that view without getting run over by this incredibly buoyant momentum on Wall Street. So let's first consider how we did. And needless to say, stocks up here again today. S&P up 1.13%, NASDAQ up 0.9%, yields down across the board, as if to tell you why it is that we have this on the menu here. And as we look at this sort of in the wake of the CPI report that we saw when we looked at this yesterday, you sort of get the sense for what it is that you're looking at. Because it seems like what you have on the menu now is perfect conviction that this September rate cut is coming. And without kind of relitigating all of why the CPI report was more mixed than one-sided, there certainly is something to be said about the contribution from goods being the biggest in over 2 years. And in fact, core goods inflation being the fastest since June 2023. There is something to be said for then the Fed's concern that tariff-based inflation is creeping into the pricing structure, and that what this will do is hurt growth, which has been the Fed's song all along. Nevertheless, the markets seem to have it figured out. Not so much in that the tariffs won't be a problem, but that as long as there's rate cuts, those problems are manageable. And for all of the cross currents in that CPI data, the market has concluded in its wake that there is a 0% chance that the Fed doesn't cut rates in September. We're looking at the probabilities here from Fed funds futures, and we can see there is a 93.8, almost 94% chance that we are going to get one rate cut. Note here, the current target range is up to 450 basis points, or 4.5%. In September, we have a 94% chance that we're going to get to a range that's 400 to 425, from 425 to 50. That's one cut. And now there's about a 6% chance that actually the Fed will go bigger. So the edge case here isn't that the Fed holds, it's that the Fed cuts more. That the Fed cuts by 0.5% and not 0.25%. Moreover, if we look at the outlook for this year and next, we can see the markets are now getting to a place where they're starting to get past just 2 cuts for this year. That, of course, was where the Fed had it. Just to remind ourselves quickly, the Fed's last forecast had from 4.4 down to 3.9 median this year. That's 50 basis points. Then from 3.9 down to 3.6 next year. That's another 0.25 point cut. So that's 75 basis points between this year and next. The markets are at 5 cuts now, not 3. And this year is getting heavier. We're out to 58 basis points here. So the market is even flirting with the idea that the Fed may need to go bigger this year. That maybe just 2 cuts is not enough. Now, it's still a relatively low probability. It's only 32% chance. We've only priced in 8 out of 25 basis points in the direction of a third cut. Nevertheless, we're in a situation here, it would seem, that the market is tilting to an increasingly dovish setting. Moreover, the view for next year is, of course, unmistakably more dovish than what the Fed has on its forecasting. In this case, we very clearly have the market telling us that there is much more scope to ease than the current pricing from the Fed seems to imply. In fact, quite a bit more is something of an understatement. We're out to 68 basis points here. So the markets see at least 50 basis points, and then the probability that they are going to get that third cut out to 75. That's now starting to look like a relatively significant, better than even kind of a thing. It's 18 basis points into the direction of the cut, so a 72% chance that it's coming. And that, of course, raises a very important question. The markets are clearly happy with this development. They've clearly read the CPI numbers in a way that gives them the enthusiasm that they need to have around these rate cuts. but they seem to be speaking out of both sides of their mouth, as it were. Because if the Fed is slow, but the markets are more dovish, then the question is, well, why? Why are the markets so dovish? What is it that they're so concerned about? Why is it that we need all of these rate cuts? What is it about the current situation that, for whatever reason, seems to be telling the markets that they need to be yelling at the Fed to do more? And that's really where we take this conversation next. Because what we find here is we're going to get a nice little test of the wherewithal of the global economy here for the rest of the week. We'll get to U.S. consumption data in tomorrow's show and take ourselves back into the U.S. But in the meantime, it's the world that is going to report on these growth indications. And we can see here there's a whole slew of GDP numbers coming our way. We're going to get a first look at numbers out of the UK. As we can see here, a slowdown of significance expected here, down from 0.7 to just 0.1% quarter-on-quarter growth, so basically standstill for the UK economy. We're going to get a second look at Eurozone GDP data, where, again, we're moving in a standstill kind of direction. And then the numbers that we're expecting out of Japan, at best, hovering near that standstill level. So, needless to say, these are sort of G5 economies. So this is where global growth comes from, outside of the US and China. And these numbers clearly are pointing to some kind of a downturn. Now, the latest numbers from the S&P Global PMI data that we use to kind of approximate where we are on the global business cycle, they seem to have given us a little bit of an upturn. And perhaps that is, to some extent, encouraging until we start to look at where that upturn, at least data-wise, seems to be coming from. So we can clearly see here that basically since the beginning of last year, the trend has been lower. We hit something of a weak point extreme here toward the beginning of this year and sort of into the end of the first quarter going into the second. And since things have kind of steadied a bit and we've come back into what is essentially the middle of this range. This is, of course, as ever, done around a center line of 50 for PMIs, where above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And these are world numbers. Now, that seems big, but of course, as we've said many times here before, world GDP really is made up of three components. It stands on three legs, of which the US is the biggest, then China, then the Eurozone are relatively equal-sized parts. That's 58% of global GDP. And the rest of world, 42%, are for the most part vendors that need the big three to be buying stuff from them in order to have demand of their own, for the most part. And so the sort of weight that demand from these three economies has in kind of determining where the global economy goes is already outsized at 58%, and in practical terms, even greater. Moreover, China is a kind of middle step economy here, where it is at the middle of the global supply chain, and again, in large part, depends on end demand in the US and the Eurozone to power their export engine. Indeed, for 9 consecutive quarters, as we've mentioned over and over here on the show, in China, we've had economy-wide deflation because there is a retrenchment from these trading partners, in particular in the wake of COVID and the reshuffling of supply chains, at the same time that there is a near total absence of domestic demand in China. And so it also is not a standalone. It also is in many ways dependent on demand that comes from elsewhere. And this then makes the situation very interesting because when you look at the S&P Global PMI numbers, the most recent update in July, you can see that both the Eurozone and China are a hair better than standstill when it comes to economic growth. And in fact, they've been stuck in this morass basically since the middle of last year. There was an attempt at a rebound in both economies, a tepid one, going into the latter half of 2023, going into the beginning of 2024. By the middle of the year, that attempt fizzles. Then you come down and you sort of settle into hugging the neutral 50 level here for the most part. Sometimes you're a little bit under, sometimes you're a little bit over. This happens to be a part of the cycle where you're a hair above, but we can clearly see these economies are flatlining. And all the strength is in the US. So when you then look at this again and you see, well, this right here, this upswing for the global numbers, that looks very much like the same upswing as what we see right here. And that seems to suggest that as long as you believe this, then the U.S. economy is the only game in town. And as long as this persists, well then, yeah, you have global growth. But without it, not so much. And then you get to the PMI numbers from ISM that you got published last week that tell you, and those were a little bit timelier than the S&P global numbers in the sense that the S&P global numbers were released meaningfully earlier. That survey includes more things in it from earlier in the month. You get this sense that timelier measures are already rolling over. And looking at the ISM PMI numbers here, you have services basically flatlined and manufacturing contracting. And both of them are pointing in the wrong direction for several months now, really since the beginning of the year. Moreover, if you look at the subcomponents, they're not encouraging either. Employment, one part of the Fed's mandate here, is in contraction mode across the board, both services and manufacturing, both of them in the wrong way here, both of them under that 50 line. And then if you want to stick with the Fed's tariff conundrum here, weak labor markets, strong inflation, here's the inflation piece. It finally took a little bit of a dip for manufacturing in the last month's report, but we can clearly see here, inflation is very much an issue here, especially in the service sector where it continues to push to multi-year highs. We're at the highest since 2022 here. So it's not nearly so straightforward that what we saw in the numbers for the U.S. out of S&P Global is in fact the latest version of this view. As a matter of fact, it may be a little bit dated at this point, whereas the standstill here remains. And so as we look at all of these GDP numbers here, more weakness in Europe, clearly. standstill in Japan, clearly. And really all we have to hang our hat on is the US. Just talked about China last week and how maybe there's some green shoots there, but very tepid and very early days yet. And certainly the GDP numbers are still awful. Maybe the idea that the US can continue to carry this on its back is fading away. And the one thing that cannot fail is failing. That, of course, appears in spades in US GDP data. We just got the second quarter numbers ahead of the last Fed meeting. And what we find is that, yes, there's a lot of shenanigans here with inventories and imports. In fact, to a large extent, this is how you end up with CPI data looking as normal as it has. On one side of it, and we'll talk about this tomorrow, no doubt, once the PPI numbers come out, wholesalers have been taking a hit on margins to insulate consumers from inflation costs. But on the other hand, of course, there was that first quarter front run where imports surged, inventories surged, so companies were stacked with goods at the pre-tariff cost structure. And what we already see in the second quarter is that imports have cratered. Meanwhile, inventories are already getting wound down. And if imports have cratered, then, of course, those inventories are not getting rebuilt. Importantly here, this is contribution to GDP. So imports here surging looks like it's going down because, of course, imports are subtracted from GDP. And when they rise, that's a negative contribution. When they fall, that's a positive contribution. The investment component here, which is where inventories live, when those inventories get packed in with those imports, that's a positive contribution to GDP. When those inventories get spent down, that's a negative contribution to GDP. And so the investment component comes down. So that's how you interpret these numbers. If these inventories are already falling, imports have basically stopped, well, then those inventories are not getting rebuilt. And so you're losing insulation from inflation, but you can see where that insulation has come from. But all of those shenanigans aside, consumption is the thing to look at because that's 68% of GDP. Everything else is, to a large extent, an afterthought. And between the first quarter and the second, you have the weakest 6 months of household consumption in the US since the first 6 months of 2020, which is, of course, the COVID recession. Moreover, we can see why the markets then want these rate cuts in the bond market. When in the beginning of the year, stocks and these break-even rates, which are inflation expectations backed out of the pricing of bonds, nominal versus TIPS or inflation-adjusted bonds, we can see that both stocks and these break-even rates fell because initially the tariffs amounted to a growth scare. Once in April, the worst of that panic went away. Stocks, we can see, have clearly had a sentiment-driven recovery, but break-even rates have not gone very far at all. In fact, even as inflation numbers have ticked up in recent months, we can see this most recent push higher for stocks, it's come with inflation expectations coming down. And in any case, since April, they've only just steadied, but largely held in a range. And so you end up in a situation then where the market is happy that there is easing coming. We can clearly see that develop here. Again, here's the S&P 500. Here is where we have this kind of April crescendo, as it were. Stocks bottom. Fed policy expectations reach a dovish extreme. We can see things then normalize. The policy outlook gets less dovish for a bit. Stocks recover. They basically reset this sell-off. And from there, it looks like the next leg higher in the stock market is largely around more easing, getting priced back into the mix. Tellingly, priced into the mix without another panic, without there being some sort of, oh my God, growth scare or oh my God, tariff scare. And that likely speaks to what we're seeing right here. The markets want these rate cuts because they see growth as the bigger risk and inflation as the smaller risk. And they want the Fed to get in front of this thing. Well, if that's the case, then this three-legged stool that we're looking at, the three-legged stool that is global growth, is already 2 legs down, and perhaps this leg is already giving way, which is why the markets want these rate cuts in the first place. And it is then the price action in the US dollar that starts to become most interesting, because even as you get more and more dovish on this outlook, the US dollar having very cleanly declined as things got this dovish, seems to have attempted something of a bottoming in early July and from here. And while maybe over here in April there was a meaningful risk that perhaps the administration is going to undermine the very dollar-based architecture of the global financial system, once the panic got bad enough, they took a step back and showed the markets that they are not looking to do something quite so damaging and game-changing, which arguably is how stocks have recovered from this panic before the easing even kicked in. So this move here, this leg of it. And that, of course, takes a lot of the pressure off the dollar in a sort of structural way, and perhaps revives it as a safe haven in the event that things turn. So that the dollar is starting to find a bottom here, even as things get more dovish. That starts to tell you that maybe the market is preparing to raise cash. Maybe it's getting ready for a big risk aversion push. You don't see it in stocks, certainly not today and certainly not this week. But you are beginning to see a bit more interest in the cash side of things, it would seem. And maybe what that means is that the markets are, as all of this easing gets onboarded into the outlook, are moved to think, well, yeah, we're happy with the easing, but why easing? Why do we want it so badly? And the thought process goes, well, if we are definitely going to get it, then are we sure it's for good reasons? And the architecture of the growth dynamic seems to say no, which is why the markets want it, but which also poses a significant gravitational risk for sentiment-buoyed stock markets. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Ragin and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Back with Chris Mondays and Fridays for Futures Power Hour, writing for the news and insights portion of tastylive.com, opining at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
New all-time highs for the S&P. That's your Wednesday. It's overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Midtown Milan, here to join you for the rest of this hour. Futures market closes at 5 Eastern, 4 Central. If you're joining us on the platform, Tasty Trade on the website, tastylive.com. Come over to YouTube. Tell us what you're trading today. What do you think of this market action? A little midday dip for stocks was no problem because we closed the session here on the highs. The S&P 500, 64.91, a new all-time closing high here for the stock market on this Wednesday, breaking through the highs that we saw at the end of July. Likewise, the NASDAQ, which spent a good chunk of the day in the red, finishes higher, up by 0.03%. It's a new all-time high. And the Russell's rip post-CPI, that continues up to a fresh yearly high here. There's lots of risk taking in today's market. Silver's bouncing 1.5%. Bitcoin's up over 2%. Ethereum up 4%, approaching $5,000. Wow. Risk is on. Dylan, our star of the supernova. How you feeling today?
A little, the problem is I think I didn't sleep well or something because I spent a bunch of time thinking today.
Oh, God.
Yeah, it was a disaster. So, so I didn't do anything, but at least I have the things that I had on, and it's ultimately more good than bad. But it just seems wacky, the whole thing. But anyway, I think it's the lack of sleep. So my conviction level is actually diminished, but I wouldn't overinterpret that as anything other than sort of the risks of thought.
See, this morning I did the opposite. I woke up, I got an IV, vitamin B, taurine, magnesium, Toradol,
You gotta get
Zofran.
potassium in there too. If you're gonna
Don't worry.
creatine.
I got that shot that makes it taste like Flintstones in your mouth. I'm ready to run through a wall. What rib pain? There's no more of that. And that was, and I said, I'm feeling pretty good today after I came home. Time to buy more stocks, Mr. Radigan.
Look at you.
So I'm back in. I'm looking out now on the longer term basis, 48 days. Little thing, just dipping our toes in. Pinocchio wants to wet his beak here a little bit. It's a Godfather reference. Long the 6,700, short 6,750. It was fun, Ilya. No, it wasn't. Being a bear
No, it wasn't.
for the past 2 weeks, or even directionally neutral. But the breakout in stocks is at least there. We were talking about this yesterday on the show. If we see the further progress, it looks like there could be rotation afoot. Maybe that gives the S&P 500, the Russell, more room to run. And sure enough, they are leading our NASDAQ here today.
Yeah.
So, Ilya, I think you have declared this poking of the bear finished.
Yeah, you have to trade with the price action. This is where you have to remember that all of your thinking, if you so choose to engage, does not mean anything if the price action isn't complying. And so, in so much as we had a break of the high on the S&P today, you had a break of the high on the NASDAQ today, or yesterday, you had a break of it on the Russell today. I'm not fighting that. No, thank you. And this is why I poke the bear with cheap vol risk-defined verticals. Across all three indexes, I ended up giving away less than 1% of equity on each attempt. This is why I do it that way. This is why I build tons of duration into these things to dilute exposure to delta. This is why I use ETFs and not the futures, to keep things small, to keep risks contained, because there's always time to scale up if the price action goes your way. Price action didn't go that way here, clearly, so I'm out. Okay, we'll try again when it seems like there's an opportunity. But the risk reward has been reset here. I don't think it looks awesome in either NASDAQ or the S&P, but it looks solid in Russell.
Dylan, this stock enthusiasm was across the board here today. I even saw a company by the name of Bullish have its IPO.
Actually, I visited the New York Stock Exchange today from Milan, interestingly enough, and noticed the banner on the building. Using my teleporter, of course.
Naturally. The company IPO'd on Wednesday in a range of $32 to $33, which valued the company at $5.4 billion when it opened, putting it right now, given current prices, it has a $13.2 billion debut, now at $70.91. Not too shabby, Mr. Radigan, but it's a crypto company that's surging here out of the gates on a day when we have crypto pummeling the market, moving up to new highs. I see this as a new high close in the BTC futures contract. I see this as a new high close in the Ethereum contract right now.
Mm-hmm.
Is this a macro story, Dylan? Are you looking at the money leaking into the world of crypto? And is this something bigger in the state of play that maybe we're not paying attention to?
Boy, I mean, I guess I'll focus on what I feel like I know and sort of avoid what I don't know. The biggest thing that we know, and I think you hit on this the other day, and I think we sort of probably haven't hit on it enough recently. We hit on it a good bit a few weeks ago. The Trump tax legislation is so beneficial to the rich, and it so encourages the flow of money into assets, because people who already have a lot of money, when they get more money, don't necessarily buy more things. They just park the money in financial assets or real estate or art or whatever it is. And so I do kind of wonder to the degree to which that is a factor in all of this. You know, even in the sort of the ebullience of the supernova, is it entirely driven by AI? Probably not, right? It's probably driven by macro factors about the flow of just the availability of cash money. And so I think that that's a meaningful consideration. I do, you know, Ethereum, why would Ethereum suddenly break out? Who the hell knows, man? You know, why didn't Ethereum do anything for the last couple of years? I mean, you could make a case that, well, now because you have the crypto president, that it's all crypto positive, but why now? I don't know. You know, is it an indication of negative dollar sentiment? I don't know if it is even. You know, I do think that when it comes to the idea of not thinking and instead, you know, buying assets, that buying an asset that is crypto should be on the buy sheet. It shouldn't just be, you know, Meta, Nvidia, and Microsoft. Even though when I think about crypto, I have to really ask questions.
I mean, I think when you look at sort of money chasing assets here, you get to a conversation, especially on a day like today, where you have a further winding up of Fed rate cut expectations. The markets are now starting to lean in. Maybe the Fed will do more than 2 cuts this year. I mean, the bonds rally today pretty significantly, and you get this sense that the market has just fully embraced this kind of a risk-on perspective, saying, oh, well, the money's going to be cheap, allocate accordingly. And so you see it across the board today. If we look at what the markets are baking in now for Fed stimulus, it's 125 basis points between this year and next, and this year has gone out to 58 basis points. That's the most dovish it's been all month this month. And if you look at next year, you're at 68 basis points, which is way more than what the Fed has. And the cumulative 125, I mean, we're talking 5 rate cuts to the Fed's 3, and that's the most dovish we've been since basically NFP. So we're in a place here, seemingly, where money is perceived like it's going to be cheap, and the economy hasn't, in some sort of an unequivocally obvious way, fallen apart. So money is just pouring into risk. The dollar's a little bit lower today. You're kind of seeing it across the board. And it looks like Chris is having some.
We lose Chris?
I think so. I think so. I can still see his charts, though.
What I'll get at, because all of this, even though I know I've been the champion of not thinking, man, it seems like if there was ever a time to consider a little short nibbling, just on the price momentum. I mean, I guess I'm I'm totally contradicting myself, and I'm sure it's because I didn't get a good enough sleep. But I just feel like the sort of uncorking today on that we're going to get all the things that you just talked about, Ilya. Like, if I wanted a short nibble, where would you put me? I guess it'd be my question.
This is, I think, one of those times, and this is why I sort of cleaned house today. This is one of those times where, for me, I need to see a price action signal. When I saw the price action signal at the end of July, showing the market is shrugging off good news, it's embracing bad news, it's starting to roll over, you go, okay, the price action is whispering things here. Let's take a shot. Let's see. Vol is cheap. Yes, yes, no, no. And I just don't see the price signal here. So I think rather than saying, okay, I'm going to bet that equities are wrong, you might instead look and say, well, I'm going to bet that the bond market is right. And say, okay, well, either the equity market is right or it's wrong, and it can, as we know, remain irrational longer than we can stay solvent. So you have to be careful.
Thus, my whole thinking issue. But yes,
right.
So then, how do you square today's bond market action then? Because I will tell you, today was a difficult day for me in my mental model of how I'm viewing the market. Right. I think yesterday was a big regime shift with the way small caps performed. We're going back into reflation. Fine.
Maybe.
How are bonds are going back up though today? Gold's not benefiting.
I think that's what it is. I mean, look at the Fed funds futures pricing, look at the bonds. I think what we're seeing today is optimism about the cheap money is coming to save us all. And whether that's
meaning that the CPI was a green light for rate
meaning the CPI was a green light.
Well,
meaning the CPI was a green light.
CPI being a green light or not, we've now had how many months where we've been running above the Fed's target, Elia? 67?
Oh, I'm not suggesting that the markets are right to think that we have a green light.
But if the green light being, let's say we're getting the Fed cuts, what does that mean for asset prices? Yeah, they're going to let inflation go up more. But Dylan, it effectively, the market is now repricing a Fed's inflation target from 2% to basically 3%. Like if the Fed is going to be conducting looser monetary policy in a world where, if you look to the Atlanta Fed's inflation dashboard, every single metric is flashing red. But the economy is not slowing down. So if you're projecting cash flows and equity valuations expecting 2 to 2.5% inflation in perpetuity, what does your growth rate look like if you're going at a 3% run rate? So we're going to get looser policy, but this is certainly not a thinking question. If the Fed's inflation target is 3%, is that A, materially different than a 2% target for businesses? And if it's not, are equity markets undervalued? It's a stupid question. It's a stupid question.
The market has been saying
I think it's the right question. Go ahead, Ilya. Sorry.
The market has been saying for months, right, that inflation is not an issue. And it's not because they don't see the tariffs being inflationary, because that would be silly. What we are instead seeing is the market saying the tariffs are going to be such a hit to growth that part of it will be more disinflationary on growth grounds than the upside shock is. And the Fed, because it takes a single rate cut anywhere from 12 to 18 months, typically, to work its way into the economy, the Fed needs to get in front of this thing. Because if we look at the break-even rates in markets, they've not really recovered since April. They've been in a choppy range. But whereas stocks have rallied, inflation expectations, market-based, haven't really gone anywhere. They've stopped falling, but they're, for the most part, anchored in a kind of sideways band.
Mm-hmm.
And so the market is telling the Fed, yeah, inflation measures might be high now, but you don't need to worry about anchoring inflation expectations. This is not going to spit out on you. You can start to pave the runway because we're going to need it, because otherwise you're going to miss the window.
Mm-hmm.
And the markets, for their part, are now convinced there is a 0% probability in Fed funds futures that there is no cut in September now. 0. It's 94% almost of a single cut and a slight sprinkling, a soupçon, if you will, of a probability that you get 50 basis points in September. The markets are sort of fully running head first into, we are going to get easing, and it's going to be wonderful and glorious, and it will paper over all of our sins.
Thus, the no-thinking supernova thesis gets stronger, not weaker, in the face of the CPI green light, which oddly then caused me to think.
Yeah, so, and the thing is, you would be forgiven for thinking, because when you look at what the CPI number was, you saw tariff-based inflation in it. It's leaching slowly because obviously the first quarter, everybody ramped up inventories, and so you haven't seen the full inflation increase in prices yet.
Mm-hmm.
You're seeing in the PPI data, and we'll see more when they're updated tomorrow, but for 3 months now, you've seen that intermediate level inflation is getting bogged down because businesses are taking it into margins and not passing it on, even to more final wholesalers, never mind to consumers.
Mm-hmm.
It's just slowly starting to leach. So, of course, the inflation numbers are going to get higher because they can only take it on the chin for so long. I think from the market's perspective, what they're saying is, yeah, but when all of this hits, it is going to be such a growth nightmare that you should be getting ahead of it now.
Mm-hmm.
I think the real question, I mean, obviously we have Jackson Hole coming up next week. If we get a Powell speech where he's like, yeah, maybe we're going to have to be slow, maybe we don't see an urgency, the markets are all kinds of up in arms, but we don't know really what that's all about. If Powell doesn't reinforce all of this, if he doesn't stamp it, that's going to become an issue going into September. If all of a sudden the markets find that all of this dovishness is wrong,
catastrophic. I mean, this thing, that's why I'm saying I got sort of sucked into some thinking, which was, you know, especially with the upswing and the green light, like it just feels really, really perfectly, you know, the cliche of price for perfection seems very sort of apropos. I don't know if it's a soupçon, but I do believe it is apropos.
Well, and quite right. And the moment that this market shows a sign of weakness, like if the S&P, let's say, dips back below its July, like late July going into August high, if this breakout fails, I'm right back short.
Mm-hmm.
That would be a tremendous signal here. I mean, stock markets love to squeeze sellers out. So Perhaps this was the last kind of smack on the chin, and then it turns once everybody has experienced maximum disappointment from all sides. But the price action will say that. It will show us.
I mean, do you understand my thought, Chris? We've lost him once again.
Yeah, it
just feels too good. I mean, I'm all in favor of the goodness, but this was ridiculously good.
Yeah, I mean, you get to a point, and I'm going to talk about this on Macro Money today, but you get to a point where you have to start asking questions about economic growth and whether gravity exists. And there seems to be this kind of cognitive dissonance between the markets going, oh, goody, rate cuts,